Some stocks will be good money makers over the next 2 to 5 years. This market is not easy anymore. You got to work for this now. You got to work for your money now, okay? AI is not going to be bigger than the internet. 100% convinced of that. Not even a doubt in my mind. I'm not banking on that. But what if it happened? No one's ready for this, man. Low risk and high reward the next 5 years. Buy and don't stop. Who knows? You could talk about that at some point, maybe in the 2030s or the 2040s. I don't trust any rally in this market short term. I mean none. Whatever happens here short term, if we have a 10% correction, a 30% crash, whatever happens in the next few months, just understand it'll all be a blip on the radar. All that will not matter 3, 5, 7, 10, 20 years from now. But it's going to matter in the short term, right? In terms of the whole fireworks and the drama show. You got to be flipping my flapjacks. It happened once again here today. Welcome into the reaction channel, folks. A lot to discuss in today's video. Everybody watching this, you must understand we are now in a massively different stock market than we were 2 weeks ago, 2 months ago, and 2 years ago now at this point in time. And so I really need to explain to everybody, I think this is a great market to really learn in. What the market we're going through right now, phenomenal to learn out. And it's very important I explain what's going on in this market now at this point in time. When you're seeing this type of activity you're seeing on a daily basis, when you see an announcement like what came out here today regarding Snowflake and Palantir, I'm going to talk about what that means and how to view this on a let's call it a higher lens from like a overall what's actually going on in the market and what's moving these stocks, right? We just had AI investor sentiment flip back negative again. We'll talk about what that means for the stock market moving forward. So just a lot of like, I guess it's going to say kind of like teaching, giving like my 17 years of knowledge out to you guys at the beginning of this video so you can kind of understand why the market does certain things, what you need to be doing now, not only from a money perspective, but also from a mentality perspective, because you got to approach a stock market like we're going into now, very different mentally than you were approaching the stock market a month ago, 3 months ago, 6 months ago, things like that. Okay. From there, I want to go ahead and actually react to one of my own posts I did on X here today. I showed my top 10 largest positions in the public count. I want to talk about if I was forced to buy those stocks, which ones I would be most excited to buy right now. I think you guys are really going to enjoy that piece there. From there, I want to go ahead and react to this video. It's a mistake for investors to move to cash when rates are declining, says JP Morgan. Really looking forward to reacting to that one. And then this one, I want to react to the Wall Streeters, talk about their views on how to handle this market from here. I appreciate everybody joining me as always. One thing and one thing only I need from you guys. If you could please just hit that thumbs up button. If you have not done so already, just please hit that like button. That's all I need from you. That's my payment for this video. Okay, just hit the thumbs up button. Additionally, if you want to see more of my videos in the future, make sure you're subscribed here to the channel. If you're subscribed, YouTube, higher probability they'll show you these videos in the future. If you're not subscribed, lower probability. So make sure you are subscribed here to the channel. Congratulations to the 5 members of my private stock group that just hit 7 figures in the past week. That's amazing. So happy for you guys. My wife just sent out those guys here today. I signed them all up last night. So very, very exciting for you guys. And maybe not so exciting for me. I just spent $32,000 last night on 6-figure trophies. I had to order a big batch. A lot of people hitting 6-figure club right now. Very exciting. I'm sure there'll be a lot more over the next, year. So I ordered a big bunch of them, $32,000 worth. So my house is about to be filled with 6-figure trophies. And that was after I spent $3,000 on 1000X hats for the 7-figure club. So man, we're spending the money out there. By the way, if you want to join my private stock group, private wealth group, get access to 1000xstocks.com, and you have less than $100,000 net worth, make sure you do that ASAP, because effective January 1st, we're moving to minimum $100,000 net worth to get in there. At this point in time, we're over 2,000. I think we're over 2,000. Yeah, we're at 2,500 plus members now in the private stock group. My goal is to usually keep the private group under 3,000 members. So basically, we're putting in this kind of limit on, net worth starting January 1st, essentially. So, that way it doesn't get too out of control in regards to Discord chat and just, too much going on. Okay. Alrighty, guys. So let's talk about where this market is. Let me teach you a little something. Okay. So listen, if you look at the trading activity today, what does it remind you of? It reminds you of what we've seen the last several days. The market will open, look like it'll be a good day. Right. And maybe even reaches a high. maybe in the first few hours of trade. And then at the end of the day, it just kind of keeps weakening and weakening and weakening. And this is a clear trend. You could pull up the NASDAQ and see this. You could pull up crude oil and see this. You could pull up Bitcoin. You could pull up Ethereum. It doesn't really matter what you do. And very end, right before the trading day closes, maybe it tries to go back up a little bit, but it doesn't even come close to recovering where it used to be earlier in the trading day. And that's what we're starting to see now at this point in time, which is very different, massively different than the market we are in, let's say, a few weeks ago, a month ago, 3 months ago. Because in that sort of market, even if the market opened low, it was going higher by the end of the day. And it would strengthen, if anything, as the trading day went along. And next thing you know, you would close that market and it would be a new high. And it's like, geez, somehow the market magically ended at a high. And now we're in a flipped market where essentially, you end this market and it just is a lot lower than the previous high it had reached. Now, to illustrate this point in even a further extent here, you look at Palantir today. Snowflake and Palantir stock, I guess the stocks jumped at first. They did finish red though. Snowflake stock jumps on Palantir AI partnership, right? Now, you got to understand this market is dramatically different than we were in. Anytime Palantir got any sort of, we're doing a partnership, anything that was remotely good news, Palantir stock was jumping 3, 4, 5, 6, 7, 9%. Boom. Now we're in a place in this market when Palantir can announce a partnership, good news, something like that, and the stock market doesn't go up. It goes down. And so you got to understand we're at a different place in this market now at this point in time where you got companies that have ran huge, even if they come out with new partnerships, good news, the stocks are ultimately not going to do a thing or maybe even downtrend. They can't hold their gains. And you got to understand when you get into that sort of market, if anything starts to go wrong, anything bad happens, the stocks are prepared to go down dramatically in the short term. Dramatically. Not like, down a little bit, like 1% or 2%. No. You get anything bad, sort of bad news for these type of stocks now in this new market we just moved into, you'll see a stock go down 10, 20% in a day. It'll be in a day. And so you got to understand, we're at a very different market and how you approach this market's very different. Now, additionally, what we just witnessed is the AI investor sentiment flip back negative again. Okay. So if you look at how investors are feeling about the market in the next 6 months, it just flipped back very, very negative. It had been positive for about 4 or 5 weeks straight after it had been negative the whole year. Now, the thing you got to understand about when you flip back negative is usually many times the biggest moves down in the stock market come over the next few months after you flip from, people were really bullish over to that bearish side. A good example of this is at the beginning of this year. At the beginning of this year, January, people were overwhelmingly bullish on the market. Then we get a flip in February. People start going bearish on the market. And then they just continue to go more and more bearish. And what did we witness? March was really rough for the market. The market actually peaked February 19th, if I recall, and then it bottomed about April 9th. But essentially over that next bit of time, when you had that first flip, that was just a start. And then over that next couple months, people got even more bearish and more bearish and more bearish. So when that flip happens, it's a very important time. So where could the stock market go, over this next 2 months? In my opinion, if I had to guess, I would say lower. If you forced me, let me say this, okay? You're like, Jeremy, you have to place $100,000 wager that the stock market is either lower or higher 2 months from now. Now, I wouldn't want to ever place a bet like that. But if you forced me and I had no choice, do you know what side I would bet on? I'm Mr. Optimist. I'd like to look at the glass half full. But if I had to guess, negative. I would put the $100,000 in the market being lower 2 months from now than it is today, given a multitude of reasons for that. Okay. And also getting the confirmation with the way the market's acting now at this point in time. So now I don't go selling out of my portfolio or anything like that, but you got to attack a market like this different mentally. This is not the market. You got to expect the market to bail you out, where the market just drifts higher and drifts higher. If you're in bad companies, they're going to perform really, really bad in this environment. If you're in very overvalued companies, they're going to perform very bad in this environment if the market can't save you. If the NASDAQ just goes up every freaking day, it's pretty easy to just be in high beta stocks, right? High growth stocks. They're just going to go up day after day after day. But as soon as that flips, it gets rough quick, right? And we witnessed that in 2022. For those of you that were not participating in that market in 2022, from the peak in Q1 2021 to the trough in Q2 2020 or in Q4 2022, you watched many of the biggest tech stocks in the stock market go down 50 to 80%. I'm talking Meta. I'm talking Shopify. I'm talking Netflix. I'm talking many of the most respected companies. Nvidia was down about 50% peak to trough in that. AMD was down even more, if I recall, right? So now I'm not calling for we're about to go into a 2022 situation, but what I am telling you is like, just understand, be mentally prepared that if this market goes south a bit here over this next 2 months, just be prepared for a lot of these stocks to go down 10 to 30%. You have to be mentally prepared for that. If you're not mentally prepared for that, you're not ready to be a long-term investor in this game. You have to be prepared for stuff like that. Now, does that mean all stocks are going to go down 10 to 30% in the next 2 months if the market gets a little weak? No. Because there's some stocks that have already been heavily damaged. They already have very attractive prices. Doesn't mean they can't get hit a little more. Keep that in mind. But what you'll see is many times, the more the market goes down, the more people start to get fearful. The stuff they start to float out of is the riskiest stuff, is the stuff that attracts a lot of margin. So those ones sell off the most in that sort of environment. So the stocks you should be buying here recently is a lot more of the value names, a lot more of the dividend type stocks, and maybe even some turnaround plays. That's the stocks you should have been buying here recently, right? As far as if this market goes south over the next 2 to 3 months, right? What are the type of stock, like let's say hypothetically the S&P 500 goes down 10, 15% over the next 2 months. It might not happen, but let's just say hypothetically it happens. What type of stocks should you be buying in that environment? In that environment, you need to be likely buying growth stocks, because growth stocks will be hit heavily. You set an S&P 500 down 50, let's just say hypothetically 15% S&P 500 down over the next 2 months. That means the NASDAQ will probably be down, I would say at least 20%, if not 25%, because the NASDAQ's almost like a call option on the S&P 500, right? And so if you get a NASDAQ down, let's say 25%, you're going to be looking at a lot of these growth stocks are going to be down 40% plus. 30% will be customary. 50% is possible. And so that's your opportunity to then come in growth stocks. No different than the best buying opportunities in April were what? Growth stocks. You know, AMD was $80 in that April fall, right? And I mean, look at AMD now. If I recall, Nvidia fell, I don't want to say Nvidia fell under 100 in that April drop. Did it not? Right? You can look at Shopify. You can look at all those type of stocks. Look where Amazon went. Look at just about everything growth related in that April drama we had earlier in this year. The best opportunities to buy were those growth stocks. Look at ELF stock since then. ELF stock bottomed around $50, did it not? ELF stock today, I think you have to pay, what, $130 for it? $140 a share? That's a little bit more. That's a little bit more. Look what Celsius stock has done since then. So understand when you're already in a crash or a major correction in the market, the best opportunities are the growth stocks, okay? When you're in a raging bull market that looks kind of toppy, your best opportunities are values or divs, and maybe cashing up a little bit and taking some profit. So do keep that in mind, ladies and gentlemen, okay? Next up here, I show my top 10 largest positions in the public account. And so, you know, which one of these stocks would I be the most excited to buy today? By the way, if you ever want to follow me on X, I always have that linked in the description area of all my videos. So I also have my Instagram link down there if you want to follow me on Instagram. But X, I post a lot of stuff. Instagram is a little bit more lifestyle stuff than stock stuff. X is a lot more like stock related stuff. So my top 10 biggest positions are Meta, AMD, Amazon, Celsius, Nike, Palantir, Cheesecake, Estee Lauder, Elf, and SoFi, which should not come as a surprise if you watch my channel a lot, right? Now, in regards to those stocks, which ones would I be the most excited to buy today? I mean, Meta, I would still be very excited to buy that today. Meta's trading at a forward P, a likely do-si-do right now, 22. Meta's a top 10, Meta's a double-digit grower, top line, bottom line. So guess what, ladies and gentlemen, like, you get a forward P at 22 on a stock that grows double-digit top line, bottom line, it's a buy, right? And with one of the best income statements, balance sheets, cash flows you'll find in the world, with Zuckerberg leading that company, like, buy, right? Is it as great of a buy as it was a few years ago? No. But you can't always expect, I could look at prices of stocks during the great financial crisis and be like, I want this stock. Like, it's just, it is what it is, right? A house in Vegas was like, $200,000 back in the great financial crisis. And I think an average home today in Vegas is like, I want to say like $500,000 plus. Could be like, oh, I want prices at this, but it's like, no, it's not realistic, right? AMD, for instance, I think that's still a good buy. Is it as attractive a buy as it was 6 months ago? Certainly not. But is it still a moneymaker? Yeah, because AMD is likely headed to 400 plus in the next 24 months. And there's a potential it goes 500 plus. So AMD is still a buy. Amazon stock. Looking at Amazon here, definitely a buy here. I love Amazon. I've been speaking a lot about Amazon recently on the channel. Not really this channel so much, but the main channel, Financial Education. So make sure you guys watch that channel too. But yeah, Amazon, whew. Listen, if I had to think about what some of the best risk reward stocks are in the market in terms of very low risk the next 5 years and a high probability of doubling up your money, you know what stock comes to mind? Amazon. Amazon comes to mind. Like, if I think about what are the chances you lose money on the stock the next 5 years versus what are the chances you double up or more than double up your money, Amazon's like, I think, one of the best opportunities you can possibly find in the stock market in terms of that. I think it's top 5 stock in terms of that, right? Celsius, growth beast, that, look at Celsius, bucking the trend. Market can go red today and Celsius still goes green. They've got a very special thing going on with Celsius in terms of growth numbers. So at the end of the day, like, Celsius just sees momentum really regardless of what happens in this market right now, right? Nike's, I think, suffering from tax loss harvesting here at the end of the year. So I wouldn't be surprised if the market goes lower. I wouldn't be surprised if Nike goes lower right along with it, because you're going to get tax loss harvesting, right? You're going to get people to say, you know what, I'm going to go ahead and take profits here, or not take profits, take losses against their profits. Oh my gosh, if anybody made profit on Nike, they must have been holding it for the last 20 years. Sorry, I lost my train of thought there. My kids were out there playing with the clowns in front of the house. They're out there messing with those clowns. It's Halloween time, okay? Palantir, I definitely don't like Palantir as a buy right now. I'm only holding those last 1,000 Palantir shares just as a kind of like, what if I'm wrong on Palantir? Because I think that revenue growth starts to decelerate in 2026. But I'm like, what if I'm wrong? Like, what if Palantir keeps accelerating revenue growth and goes to like a 60, 70, 80% level or something like that, right? I don't think that's going to happen. Otherwise, I would have still hold every Palantir share I have. But if it happens, I'm like, at least I still got a little bit of skin in the game. But that one I definitely would not buy right now. It's very, very high risk. Very, very high risk stock, right? Cheesecake Factory. And when I say high risk stock, I mean, like, what are the chances it gets cut in half? It's pretty decent. But the great news for Palantir is at the end of the day, they're still going to keep growing regardless of the economy, regardless of any of that. At a very nice double-digit clip. They got a great balance sheet. Obviously, Alex Karp knows what he's doing. So it's not risky in terms of like, is this company going to go to zero? No. But could that valuation get cut in half and the forward P go from a 300 to 150 if revenue growth starts to decelerate? Yeah, that's perfectly fair. And that takes Palantir from a stock that's 180 down to $90, right? So just something to kind of keep in mind there. Cheesecake, I love Cheesecake here. I understand there's a lot of worries about the consumer, the economy. That's all fair. Unemployment, all that sort of stuff, right? But at the end of the day, Cheesecake, you got to understand, here's the thing with Cheesecake. It's not the worst thing if the economy and jobs market gets a little worse over the next 12 months for Cheesecake. And the reason being is they need to build a lot of North Italias and Flower Childs next, I would say, at least 5 to 7 years, if not the next 10 years. So if you can have interest rates come down, they can take out debt for cheaper, right? So they can build a lot more locations. They'll be able to get labor easier for their restaurants if unemployment goes up, right? And additionally, construction costs will be basically flatlining or going down if that sort of situation happens, right? And they might even be able to get land for cheaper as well. So if you were to talk about a economy that was a little weaker over the next year, and once again, that might not happen because it's also possible the economy strengthens, but let's just say hypothetically it weakens, right? Cheesecake's in a great position. You can say, well, maybe their restaurant sales will go down short term. That's fine. Like, big deal. Like, that'll come right back as the economy comes right back. But the moral of the story is the biggest opportunity is those two expansions of those two chains. And it'd be much better to be able to build those as cheap as possible rather than paying sky high prices, right? Or not being able to get the labor for the restaurants that they need. or having to pay ridiculous wages because the jobs market is so tight at a particular time, right? So these are some things to all factor in here in regards to cake. Now, as far as EL, I still like that one as a buy. It's certainly not as good a buy as it was 6 months ago, right? It was like $50 stock then. It's almost 100 now, but that one's still a great buy. That one's got a huge turnaround going. I think it's going to 200 plus over the next 24 months. ELF, still a good buy. I mean, at the end of the day, I don't love it here, but I like it here still if I was to buy it. You know, when you think about how much ELF growth has for the next 5 to 10 years, it's substantial, right? SoFi, I don't love it here. I like it here still. There is a lot of worries about the banking system and things like that. So do keep that in mind. But SoFi, the growth rates have been ridiculous there. So as long as Anthony Noto's running everything at a high level in the background, like, and keep in mind, Anthony Noto's getting a lot of stuff off the books. He's managing the business in a way that is, I would say, more asset light than asset heavy. So do keep that in mind, right? Alrighty, next up here, let's react to some Wall Streeters.
JP Morgan, private bank. You're either, there's two kinds of people, I think, Monica. People that think, wow.
Oh, by the way, ladies and gentlemen, we got our new lifetime membership cards for the private stock group. These are beautiful, beautiful. So, ooh, nice steel cards. And that's on top of, when you join the private group, you get your 1000X steel membership card. And then you get your private group steel membership card as well. Anybody know what stock that is? That's actually a specific stock chart there going up. So very excited about that. This card's only for lifetime members, though, when you join on a lifetime basis.
Wait a second. Let's hear this.
Yeah.
After what I just heard, I'm wondering where this is going.
It'll be fine. It'll be fine. Two kinds of people. People that worry about how far certain parts of the market have come, and people that say that it's justified by the future of technology or AI.
Yeah.
Is it, in your view, are you one or the other, or a little bit of both?
I think I'm somewhere in the middle, which I know you're not going to like. But I think if you spend all your time worrying about the past, you completely miss. Equity markets look forward, right? And so they're looking to what the next 1, 2, 3, 5 years of earnings look like. And so if all I'm focused on is that we've rallied 90% in the last few years, then I'm never going to be on the train where it's going. And so I try to focus on where the puck is moving. That's hard. And I think at 20 plus times earnings, it is very hard to look at valuations and really get excited to put new money to work here. But it's a mistake if you just say, I'm going to move to cash, especially when rates are declining.
I can't believe Monica used the train analogy. We have used
the train.
We have used it so many times.
Off the train.
Yeah. But you know what?
The train's off the
No,
rails.
you got to be on the train. You got to be in it to win it, don't
you?
you?
For 2022, stepped to cash and said, I will come back when there's a pullback.
Still not
and
bad.
they never were able to get back in because it was never a sustained pullback that felt good. And so...
Yeah, but I mean, to be fair, I think there's very different. You know, when I'm not one of those that's like, oh, I'm going to go sell all my stocks and, you know, go all the way to cash. But listen, if I had to make an argument on going to cash 2022, right? You know, Q4 2022 versus Q4 2025, there's a way better argument to be made. You should be going cash right now versus Q4 2022. You had the NASDAQ down 35+%. When has it not been a buy when the NASDAQ's down 35%? It was easy peasy lemon squeezy. I understand all these Wall Streeters were scared. They're like, don't buy, don't buy. Oh, no buy, right? But that was the best time to buy. At the end of the day, when you got a market with sky high valuations, you can make a much stronger argument that you should be cashing up some in that sort of market, right? And so that's just wild. It's a night and day difference. Much better argument to be made. Cash makes sense now versus cash in 2022. Like, if you told me, would I rather have been going cash in Q4 2022 or right now? Right now, without question. Like, you should have been dumping every penny you had into tech stocks, every last dime in Q4 2022, because you got a generational buying opportunity. Right now is not a generational buying opportunity. Right now, it's like some stocks are good values out there. Some stocks will be good money makers over the next 2 to 5 years, but it's not everything. Like, you could have basically bought any big tech stock, anything in Q4 2022 and made a fortune. I don't care what you bought. Apple, Microsoft, Meta, Amazon, Nvidia, AMD, go through the whole list. Salesforce, every single one of them. There wasn't one of them, Netflix, Shopify, etc., etc. Go down the whole list of them. Everything. was a moneymaker. Now, some way outperformed others. Like if you were a Meta shareholder for the last 3 years, like I have been, you made fortune, right? If you're an Nvidia shareholder, you made a fortune. If you're an Apple shareholder, you did pretty good for yourself. If you're a Microsoft shareholder, you did pretty good for yourself. You didn't make like life-changing money, right? You buy Palantir Q4 2024. I mean, the stock was $7. You made life-changing money, right? Tesla, same exact thing. Tesla, I remember buying shares for $101 in like January of 2023. That was so easy. This market is not easy anymore. You got to work for this now. You got to work for your money now. Okay. Certain time when the stock market's gone through a major correction or crash, you could even be a lazy investor as long as you just have faith. Right now, you cannot be a lazy You better know what you're doing in this market. That's why you need to go through the course curriculums in my private group. You don't know what you're doing in this market, you're going to set yourself up for massive underperformance, massive issues. You know what you're doing? You'll be able to get through this situation we have just fine and be able to take advantage of great opportunities because you'll be able to identify those.
So for bubbles and bubble talk, the other day we had someone who wrote an op-ed about, maybe we're in a bubble. Should we use less the trailing 12 on the PE? For technology, if you don't use the next 12,
you have to use forward.
If it goes up 80% in earnings, you're either at 55 times earnings or 30 times earnings.
But
it's a big difference.
With what you're saying, 100%, you were right to call Jared out on using.
No, I didn't really want to call him out, but
you were right to do it. But my question is, when you're in a bubble and the bubble bursts, the forward turns out to have not been true.
You're wrong.
Do you believe the forward?
You know the past, but you never know the future completely.
Yeah, I think analysts are reasonably good at looking out the next couple of quarters, right? They work with companies, they can figure out where things are going. The challenge, and why many have been wrong about AI, is it's really hard to look out 3 years and something like this and figure out what is the impact on margins, what's the impact on growth.
Fast.
We don't know. And it's like, if you believe the J curve, which is the argument to be bullish AI now, you have to assume numbers are too low. That is tough to do. And I'm not going to make an argument that the S&P should be at 25 or 27 times. I think that's probably foolish. But to use trailing, I just think is probably very inaccurate because you're not appreciating the upside. And I work at a bank, right? You see all the ways that AI has changed the way we do work day to day, the way we become more efficient, the way we underwrite credit, things like that. Like, it is going to change the way we all live and work over the next 5 to 10 years. And it's really hard in someone in my seat to think about what 5 years from now looks like. So it's a bit of guesswork.
But the money that's been pledged for what is really the build out of AI, it doesn't exist right now. I don't know whether it's going to be printed. Can you make that point a lot? That money does not exist right now.
Right.
Those trillions. So how much faith can you have that that's going to actually be there? And then the thing I have is, the build out's great. Yeah. All the CapEx expenditures, it's going to be like building infrastructure. It's going to be amazing. Is it a payoff commensurate with the trillions that are going into it for productivity or for whatever it's going to do?
We just don't know yet. And everyone's looking at earnings, hoping that companies will say this, but I don't think they know yet, right? It's a little bit of a leap of faith. So when you look at what's being spent, we're watching very closely, what is the free cash flow these companies are generating? Are they levering to do this? Not yet. If that starts to happen, I think you should become very concerned about a bubble. And so that's going to be a big thing to watch. But I've also been speaking with clients who want to get more into AI, and you say, okay, yes, you might want to play the hyperscalers, some of the semi names, but you should be looking at the second and third derivative plays. Where are the sectors that will undoubtedly benefit, but probably have underperformed, have lagged? I think about things like healthcare. That has been a huge laggard. And I don't know how you can't imagine that in biotech, AI is going to change the way you innovate and drugs come to market.
That's true. I will say one of the things that happened yesterday when I read a little bit more about it raised a brow. The sex open AI sex bot thing that we were talking about. The Sam Altman's now like, you can use all of these sex things.
You're going to have to tie this to yesterday's market somehow?
Well, I am actually, because in August, Sam Altman apparently said on I don't know if it was a podcast, I think it was a podcast, Sam Altman said, we're never going to do things like sex bots because that would get in the way. We don't have to do that. We don't have to do those things that would juice the numbers quickly, but we're not going to do those things because they would interfere with our long-term goals for what we have for this. So if a few months later he's now saying, okay, we're going to juice it and get the numbers up, is he worried now about being able to show the revenue at least more quickly than people had thought before?
Yeah, he's got to jump on the porn bandwagon to really maximize it. Because you got to get the porn involved.
But because he said that those would be things that would juice the numbers very
at the
quickly,
tail end of it,
very quickly get those numbers up, and it makes sense.
But when we talk about it, it's why you have to have a diversified approach. I think it's really hard to say who's going to be the winner and which is the one company. I'd be very cautious putting all your eggs in one basket. But again, you diversify. I think it's hard to imagine a world where 10 years from now we don't look back and say, this was as big as the internet was. And so how do you play that? You got to play it in multiple ways. Just be cautious of valuations. Do some in private, do some in public.
I don't ever like that when they say, oh, it's as big as the internet. It's going to be bigger than the internet. Listen, baloney. AI is not going to be bigger than the internet. 100% convinced of that. Not even a doubt in my mind. Like the internet is what enables AI. Like, what are we talking about here? Like AI, the internet is AI's dad. It can't be bigger. Like, no, what are we talking about here, man? Like the whole world runs on the internet, right? And even if as AI gets bigger, it still runs on the internet at the end of the day. And all the internet companies, like who are all the companies spending on this? They're all internet companies. Like it can't be bigger than the thing no, it's impossible, right? And so this is not as big as the internet. It's a big opportunity, right? It's going to help companies be more efficient. It's going to help creators be more efficient, marketing professionals, all those sorts of things, right? It's going to help kids in school probably cheat on their tests better, right? All that sort of stuff. And so it's big, but just because it's big doesn't, like, quit saying it's bigger than the internet. Like, the internet's its father. Like, come on, man. Like, what are we talking about here? Okay. Alrighty. Next up here, how to trade the market volatility.
The shutdown rolls on. The trade war rolls on. The Russell is still having its best week since 2024. It's up 5%. We're watching that. It is the largest decliner. Gold, another record high. That's like a broken record, obviously. But Josh, even with this volatility back, it doesn't feel to me as though people are really changing their big picture view. Goldman's Tony Pasquarello today, whom I love to quote, says this remains one of the most dynamic market environments I've ever seen. Looks at the banks as a litmus test on many of the big questions that exist and says, quote, I thought the takeaways from Q3 earnings were very encouraging. And what that does for me is it underscores why people remain bullish, because earnings and the expectations that they are, in fact, even though they've just started, they're going to be encouraging. What do you think?
Yeah, I think that's a really important point that Tony makes and that you raise, and it's a good place to start because when you actually listen to the calls, and I couldn't do all of them this quarter, but I listened to the big ones, it's not as though the banks are telling us they're gangbusters in everything related to AI and capital markets and everything else is moribund. It's the opposite. They're seeing opportunity in every segment of the economy. It's not to say that there aren't problems. There's always problems. But the big picture, according to the banks, is that the consumer, the quote unquote resilient consumer, that whole idea, nothing that transpired during the course of last quarter and nothing they're seeing on a forward looking basis tells you that that is changing at all. And that, I think, speaks to just broad strength across the board. And you don't even really have a housing thing going yet. And housing is 20% of GDP. So if that part kicks in as rates very slowly come down, the 10-year moderates, mortgage rates come down further, if you get that 20% of the economy back into a higher gear, combined with how well everything else is going, I don't see why you'd want to make huge changes. One thing I want to call out here, because we're in earnings season, we all know how important technology company earnings are.
So what JB just said there, I think that's very important. Yeah, I view this very similar. Listen, how do you view your portfolio and these sorts of things? How do you make adjustments? I don't feel like right now you should be making like massive adjustments. I don't think you need to go, unless you've got big problems in your portfolio. Like let's say you're in like all crazy speculative, high beta, like, you know, ridiculous stocks with no business models, things like that, right? That's where you run into some trouble, like serious trouble. And maybe you got to reconsider a lot of things over this next month or two. But outside of that, you should already be in a position, if you do a good job running money, like you shouldn't have to be I'm not making massive adjustments right now. I make small tweaks here and there, right? Got some hedges on in some portfolios. I've got some cash ready to rock and roll in case this thing goes a little south. But you don't see me making massive adjustments right now. I don't need to. I'm already positioned for what we're going through in Q4. I don't need to make that's how you need to, that's when you know you really got it. When you don't need to suddenly make a massive adjustment because the market's switching a different way.
The S&P, to the outlook, to sentiment, to multiple, et cetera, et cetera. The tech sector actually has estimates being raised since the start of this earnings season. So as recently as June, the street was looking for 15.9% year-over-year earnings growth for this quarter, and now they're at 20.9%. And that's not in a long period of time. I think they're looking at all these deals being announced, and they're figuring out, this is more revenue for Microsoft. This is more revenue for Nvidia. And they've had
So it's funny seeing that first video, the futures, that was before the market opened. All futures were all super green and looked like it was going to be a great day. Now this video is from mid trading day, and look at now everything had turned red. And then obviously things got much more red over the next few hours.
Take those numbers up. And by the way, they've taken Apple's numbers up as well. We don't have those reports right now. We'll get them very soon. But if you've got the financials reporting blockbuster quarters, which is what they've done, and now you get technology companies as the follow through, why would you look at this market and say, you know what, I want to make a hard pivot and do something totally different than what's working? No one's going to do that.
Right, Kerry, because, people view what's happening with China and the shutdown as noise. They're both going to get figured out. Interest rates have been coming down. That's, been positive.
So push back against JB, though, right? Because he's kind of making this point about tech earnings should be great, and they should be, and guidance should be fine as well from Meta, from Apple, from all these companies. Market's trying to look 6 months, if not a little over 6 months into the future, right? And you got to understand, let's say, why did we top Q4 2021 on the market? Because the market saw big tech earnings were going to get much worse over the next year. You would look at, interest rates did this, blah, 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 inflation, etc. At the end of the day, the market started to sell off big tech stocks, right? They all peaked Q4 2021. They started to head down from there. Was the market right to assume big tech earnings are going to get much worse over the next year? The answer is absolutely. Look at how high the growth rates were for those big tech companies in Q4 2021 versus those growth rates of those companies in Q4 2022. It was a night and day difference. Their growth rates had shrunk massively. Some even were going negative in terms of revenues. I'm looking at you, Nvidia, okay? Some went negative. Some went to extremely low single digit. And those companies had been growing strong double digits. So if the market is concerned about recession and those sorts of things, right, and maybe growth rates will be really bad at this time next year, those stocks will have already peaked here in the fourth quarter of this year and then start to head down. So that's just something to keep in mind there. You got to, the market in general is really sophisticated. A lot of the ones that make up the market are not so sophisticated, but the market itself actually pretty freaking good at this, I gotta say, right? No different than you can say, why did stocks start bottom out in Q4 2022? We still had so much bad news in 2023. Growth rates weren't necessarily great for companies yet at that point in time, right? If you looked, actually, growth rates were still really bad for a lot of big tech companies in that first quarter and second quarter of 2023, right? Additionally, we had regional banks start to go under. But guess what? The market was right. Look at those growth rates suddenly in Q4 2023 of Nvidia, of Meta, of all these companies. They were phenomenal all of a sudden. It was what a turnaround. Jeez. So something to keep in mind.
For things like the Russell, Fed talked about the balance sheet and ending the runoff in coming months. The market took a little bit of a move higher on that. Is this a stay the course, keep your eye on the ball, avoid the noise market still?
Yeah, Scott, I think that's a good way to look at it. We've got earnings that are going to be reasonably strong. When Josh talks about what the banks are saying, I'd like to point out something that I also consider a real positive. We have had very little IPO activity until this year. We've had deals coming through. There have been acquisitions in healthcare and technology, in security and software. There have been a number of companies that look to be filing their IPOs soon. I think that's going to continue through the year. And as we know, we've had a massive amount of share purchasing over the last several years. So just bringing in more new companies is very positive. If the trade talks calm down or be resolved, which is what we've seen in the past, history is repeating itself over and over with the president and threats and negotiations.
All right, before we go further here, I don't actually look at the IPOs in that whole situation. I don't look at that as a great positive, at least for the short term of the market. Here's why. When you get a bunch of companies going IPO, they're only doing that usually because the market has been rolling for a while, right? And the market's frothy and it's like, man, we should go IPO right now because all these IPOs are booming, right? And that's what we had a lot of this year. A lot of these IPOs performed tremendous, at least when they first went IPO. Right now, I don't know about that, but they had been, so you have a lot of companies say, let's go public. Look at the NASDAQ. It's rolling. People clearly want to take risk. It's time to go public, right? And so you had a lot of that over the past year, a lot of IPOs, right? That doesn't always mean good things though. Like usually the best buying opportunity is when no one wants to go IPO. When no one's going IPO, you're usually in a bad market, which is always a great time to be a buyer. That means you're likely going to make a fortune over the next 2, 3, 4 years coming out of that, right? When everybody's going IPO, that's actually a good signal of like, okay, let's be more reserved in this market. Let's make sure we're putting our money in the very best of the best companies that will make it through any storms, that have great income statements, balance sheets, are extremely profitable, have great margin profiles, right? And will grow regardless of what happens in the economy. That's the way you need to kind of view that. Additionally, when a company goes IPO, keep in mind that sucks money out of other public companies. Because there's a finite amount of money out there. That's just the bottom line, right? And if suddenly I see, man, there's this really exciting new IPO, I want a piece of this, which I don't do that certainly. But let's say I did, money might come out of Meta. Money might come out of AMD, one of the Palantir, whatever, right? Which puts selling pressure on those stocks. So then money can go into that other stock, right? So this is all stuff to keep in mind there. So just understand when you're seeing a lot of IPOs, you actually need to get more reserved in the market.
With the situation in the Middle East resolving to a large extent, I think that the only problem people have with the market is level of valuations and concern about what's happening with AI. And I'm not as worried about that right now as some people are. So as earnings come through, I think that we can see the market hanging in here, not being too troubled, and hopefully we'll get some very strong numbers at the end of this month.
Even those who, Malcolm, are troubled, if you want to use that, with the multiple, it's not, for the conversations that I've been having of late, and some of them have been with, very important money managers, it's not derailing their overall view. And they'll say, well, okay, yeah, stocks are a little expensive. It's not like there's a lot that's necessarily cheap. But the NASDAQ today, like the multiple of the NASDAQ at its peak back in, early 2000, I don't know what it was off the top of my head, but it wasn't even close to what it is now. Yeah. So there's, in that view, and like the Paul Tudor Jones perspective, you might not love the multiple, but there's a lot of potential runway ahead before you even get close to what they would consider to be crazy town.
Well, I think the big bank CEOs take a cue from Jamie Dimon and try and give us a little bit of telling us to curb our enthusiasm a little bit whenever they deliver these big numbers, especially in record-breaking quarters like we just got done having, right? But I heard the CFO of JP Morgan say, this is the busiest summer I've ever had with respect to deal making in M&A, right? And you guys were just talking about the big banks and the impact that that's had on the rest of the markets. We've had more than 150 IPOs through September so far this year, another 50 or so slated to happen this year. That alone tells you where the appetite and the risk sentiment is for the rest of the market. Everything else, to your point, Scott, is just noise. So investors have been able to look past the shutdown, the tariffs, the everything else, and say, this is a market I still want to be long. It's not a place I want to be looking to get out.
Yeah, some stocks I'm going to really like. I got to be honest with you guys, man. Some of these stocks are so hated but I really like these stocks as buys in November and December of this year. Because I think they probably bottom. I think a lot of these stocks will bottom in the next 6 months. I'm looking at stocks like Nike. I'm looking at stocks like Whirlpool. I'm looking at stocks like Cava. These are like some of the most hated stocks, even maybe something like an RH. I think there's a good probability a lot of the far majority of those stocks will bottom. Bath and Body Works will bottom in the next 6 months, right? And then start to head up. So I think some of those could be great buying opportunities at the very end of this year and then in the first quarter of next year, essentially, right? Once you get past all the tax loss harvesting, I think once you get past the tax loss harvesting in those stocks, like everyone possible that will have wanted to sell those stocks will have sold those stocks. And then you'll only have the very strongest of hands left in those guys. And I think a lot of those stocks will be viewed as like getting more favorable as you get deeper into 26 and then you go to 27 and 28 beyond. And so we'll see how it all shakes out. Okay. I appreciate y'all guys for joining me as always. Thanks so much for being here. Once again, if you're looking to join my private stock group, get access to all my course curriculums, private Discord chat, exclusive weekly videos, the moves I'm making, my $4 million Fidelity account, the public account, all that good stuff. There'll be pinned comment down there. Click on that. Join us in there. And once again, we are moving to minimum $100,000 net worth to get in that private group starting January 1st. So if you want to get in there, you got, very short amount of time left to join us on in there. Look at the public account here today, almost an all-time high, well over $4 million. Just like that. Congratulations, everybody out there making a few dollars. If you're in the right positions, you should be making a lot of money in the market. If you're not in the right positions, it's a tough market for you at this point in time. The right positions being AMD. Look at this beast here today, up 9+%, $238 a share. We're now sitting on 113% of gains on AMD in the public account, well over $600,000 position now at this point in time. It's also the biggest position for me in my Patreon portfolio. I got a ton of shares in the public account. If you're an AMD shareholder out there, I'm sure you're enjoying life, making a whole lot of money now at this point in time. No. If you look at the market here today, it looked like it was going to be a great day, right? Market just goes roaring right from that opening bell, right? And then we just give it all back. Next thing you know, you're like, bankruptcy? Like we went from thinking about Lambos to thinking about bankruptcy. And then the market ends up kind of finishing with like a mad day. And that's the sort of stock market we're in at this point in time. Volatility is fully back now in this market. Look at the VIX here today. VIX opens low, right? Stocks up big. Then we have the whole give back of the market there. Volatility spikes up. VIX approaches 22. And then it kind of finishes in that May range, right? So volatility is now back in this market. The days of the stock market just goes up brainlessly every day. That's over, folks. That's over now at this point in time. VIX is back, and what we used to have for a market is now dead at this point in time. And then you look at a stock like Salesforce, CRM here. The stock just goes lower and lower and lower and lower. It doesn't matter. The stock market goes up, this goes down. Stock market goes down, this goes down, right? Stock down 18+% over the past year. 3 core subjects I want to speak about in today's video. First up, I'm going to tell you about some stocks you need to avoid until January, essentially, in a dynamic that happens in the market. I need to explain that so everybody understands that. Okay. Second thing is Salesforce. What's going on with Salesforce? When is that stock going to start going up? My perspective and opinions on Salesforce specifically. Third subject, I'm going to give you 3 grade A stocks that everyone out there must own, in my personal opinion. Got to own at least 2 of these 3, but honestly, all 3 are a buy. One thing and one thing only I need from you guys, if you could please just smash that like button on the video. If you can just hit that thumbs up, that's all I need from you. Please just do that. And then additionally, to everybody that's already done that, thank you so much. Thank you so much. Okay. Some of you guys hit that thumbs up right away, and I appreciate y'all in the biggest way. Additionally, if you want to see more of my videos in the future, make sure you're subscribed to the channel. If you're subscribed, higher probability YouTube will show my videos to you in the future. If you're not subscribed, lower probability. It's as simple as that, and it's free to be subscribed to the channel. Additionally, want to let everybody know, this is the first time I announced this on the main channel, but starting January 1st, 2026, it will be a minimum of $100,000 net worth to get inside my private stock group. So we're moving that up. We've now are over 2,500 members in the private group. So I'm trying to limit that amount a bit. And so we're taking you up to, you must have $100,000 plus net worth. So if you are somebody that wants to get in my private group, you have less than $100,000 right now, you got a little bit of time here to go ahead and do it. Okay. That will be the pinned comment down there. And to apply to join us in there, access to all my course curriculums, a private Discord chat, exclusive weekly videos, all that good stuff, plus all the moves I'm making on my $4 million public account there as well. Okay. Keep in mind, I just got this sent to my house today. This is our new lifetime access member cards. Yes, baby. That's a thing of beauty right there. So now if you join the private stock group, you get a lifetime membership. You're going to receive your 1000X Steel card. You'll receive your regular private stock group card, and then you'll receive a lifetime access card. If you're an OG lifetime member and you want to receive one of those cards, reach out to Trevor. He can send you one of those complimentary. Okay. Alrighty, guys, let's get rolling here. First up here, some stocks you need to avoid and why. Well, listen. If you look at the market this year, right, the S&P 500 is up about 14.5%. It's been a good year. It's been a good past year for the S&P 500. There's no debating that, right? Like, this isn't a great year. It's not like this is like, whoa, this is some insane year. S&P 500 is up 20, 30% over the past year. But 14.5% over a 1 year, you'll take that every time. If you tell me the S&P 500 can go up 14.5% every 1 year, I'll say go. I'll take that. Like, I don't need more than that. That's fine with me. I can make so much money in a market that goes up 14% a year. Like, with the sort of stocks I get positioned into, I'll gladly take that, right? But here's the thing you got to understand is when you have a market that's gone up a lot, you're going to have a lot of people that do what, right? Lots of profits being made. So that means lots of profits are going to be taken. Now, when you take a profit, guess what happens? You have to eventually pay taxes on that. Very, very important. A stock market that's been uptrending like this, people are going to take profits. Remember, a lot of people are not long-term investors. They're traders, and traders are taking profits all the time, right? And then you got a lot of investors like myself that maybe were positioned into stocks for years and years and years. And some of those stocks have maybe gotten overvalued now. And so I'm like, you know what? I'm taking profits out of this one, this one, this one. Not every stock in this market's overvalued. There's some that are significantly undervalued, but there's some that's no doubt in my mind, they're very overvalued now at this point in time, right? So if you look at the public account alone, I've taken $668,000 of profits here in 2025, right? Which means I've got a lot of taxes to pay come April, right? A lot of taxes to pay. But what I don't do, but what a lot of other people do, a lot of fund managers, investors in general, do you know what they do? They do what's called tax loss harvesting. So they'll essentially take a stock in their portfolio or multiple stocks in their portfolio, and let's say they're down on those positions. They'll go ahead and sell out of those stocks, take those losses, so then they can write those off against their gains. And this creates a dynamic where let's say me in the public account there, let's say, I got those $668,000 in gains. So I'm saying, you know what? I need something to limit my tax bill that's coming, right? So I could sell a stock that hasn't done well, right? I don't have very many stocks that haven't done well, but I could pick one of them and be like, okay, I'm sitting at a $50,000 loss on this stock. Let me go ahead and write that off against my $670 gain. So now I only have let's say $620,000 gains, which is much less. Now, this creates a brutal dynamic in the stock market where essentially the weak stocks get even more weak. So if there's stocks that have been going down, they've been trending down, right? People are going to take losses on those stocks. So the stocks that have been going down go down even more. And it's a vicious effect that many times hits in Q4. Many times it can hit in November, December. And when you get the market to trend down, it gets even worse. So what's some specific examples of some stocks that I can show you that I'm very, very concerned about this effect happening? Okay. And this is very widely known if you're an investor in the market, but here's the deal. Listen. RH stock, perfect example. RH stock down another 3.5% today. That's despite the NASDAQ being green here today. That's despite the S&P 500 being green, right? Over the past year, RH stock is down a whopping 46%, right? It's been selling on selling on selling for RH stock. If people are looking, fund managers, individual investors are invested into RH, right? And they're looking for something to write off some of their gains. Maybe they sold a bunch of Nvidia shares this year and took massive gains. You got a stock like RH, you might say, you know what? Let me go ahead and cash out of this one here in Q4. And that adds even more selling pressure on a stock that's already incredibly weak. Like this stock can't find any buying pressure on a normal day. So all of a sudden you have some people tax loss harvest. It sends the stock down even further, right? Another example of a stock, Bath & Body Works. Stock's gone down 19% over the past year. People are likely sitting on big losses here and they're looking in that Bath & Body Works. Like, is this stock really going up anytime soon? They're going to feel like probably not. So you're going to say, let me go ahead and tax loss harvest against this one. Let me sell out of this and write this off against some gains, right? Cava. Oh, Cava. Look at this stock. Down 52.6% over the past year. Oh my gosh. Is that brutal? Like danger, danger, danger in regards to Cava. Like if this market trends down a bit, you'll see Cava hitting the 40s like that, right? It's just brutal. But this is a stock that, keep in mind, a lot of growth investors were invested into because they had big growth rates. The same type of person that would have bought Nvidia stock, it's the same type of person that would have bought Cava stock, right? High valuations, but it's got the growth. But the growth rates have come down immensely on Cava, so everybody's flooded out of that stock. And now it's gone down 52% despite the stock market being up 14.5% over the past year. So you want to talk about stock that people might be sitting on massive losses. You could have people sitting on hundreds of thousands or millions or tens of millions of dollars of losses, depending upon how heavy they went, right? And they're looking and they're like, okay, I got $6 million in Nvidia gains. Say it's a small fund or something like that. They got $6 million of gains they've taken out of Nvidia this year. And then their Cava position, they're down $4 million on that. I say, you know what? Let me just cash out of this. Consumers getting weaker. Like it's not going to be good anyways in the short term. So let me write off some of those Nvidia gains against this, right? Whirlpool, another good example of this. That stock's down over 30% over this past year. Brutal. I mean, you know, you just got to keep in mind, if the stock market downtrends here in Q4, it's just going to be the cherry on top when it comes to a lot of these stocks, and they'll just go down more and more and more and more and more, right? And so, you know, you get the S&P 500 to go down, let's say 10% between now and the end of the year. That's not a huge move, by the way. Like 10% down, we would still be up 4% roughly, or somewhere around there roughly, right? Over a year basis. But let's say hypothetically S&P 500 goes down 10%. I mean, you know, you're going to see you're going to see something like a Whirlpool go $60. You're going to see something like Cava go into the 40s. See something like Bath and Body Works go do-si-do 22, maybe even lower than 22. You'll see something like RH go down 125. Maybe if the market got hit really hard, RH would go under 100, right? So just something to keep in mind there. But that leads me to another tax loss harvesting type stock, which is subject number 2 of this video. Salesforce, CRM, was one of the best, most respected stocks for the longest time in the stock market, but over this past year, it's just been thrown out, down 18% over the past year, right? And people are like, when does this stock start to go up, right? Another potential tax loss harvesting stock at the end of the year, right? November, December. So before I go further on Salesforce, let me show you my numbers. Let me show you my bull case, base case, and bear case for CRM Salesforce, okay? I have them doing 14% revenue growth per year over the next 4 years under my bull case. This is using 1000xstocks.com. Okay. I have them doing 22% net income growth. They shouldn't do a massive amount of hiring over the next, basically 26 to 29. They should run the company very lean. So much of that revenue should hit the bottom line. And keep in mind, they're going to buy back a lot of shares, so that will help their earnings per share even more. But if they can do 14% top line, 22% bottom line, in SaaS space, 29 to 34 P is very fair for a company growing mid-teens revenue, and let's call it low 20s net income. That puts a stock at somewhere between $500 and about $27 and $617 come 2029, which gives me a compound annual growth rate well into the 20s, right? But that's my bull case. What about my base case? Base case is just a fancy way of saying what I actually expect. Here's my base case. I have them doing 12% revenue growth per year on average, 2026 to 2029. I have them doing 20% net income growth, 2026 to 2029 on average. 27 to 32 P is very fair for a company like Salesforce at those sorts of growth rates in this space. That gives me an 18% compound annual growth rate on the low end, 23% on the high end. So we can call it 20-ish%. Listen, that's why I'm buying Salesforce stock right now. If you can give me if I can run my numbers and over the next 4 years, I get a compound annual growth rate of 20%, I got to take that. I can't just be like, no, let me stay on the sidelines. It might go lower short term. Maybe they're going to tax loss. No. At the end of the day, you give me a CAGR of 20%. I'm taking that, right? Here's my bear case for Salesforce. My bear case is really bare. I'm only doing 6% revenue growth per year, 26 to 29. That'd be brutal. 10% net income growth. That would be brutal for them. And then 22 to 27 PE for a company growing mid-single digits revenue and low double-digit net income there. So gives me a compound annual growth rate of about 3 to maybe 8%, somewhere in there. So even under my bear case, I don't lose money. So my bear case, I don't lose money. In my base case, I get a CAGR of 20%. Salesforce is a buy. There's just no debate. There's no debate. So the next question is, when does Salesforce stock start to go up, right? Because that you're looking at this and you're like, okay, this is great. Like, looks like a screaming buy. Looks like a great stock to buy and be loading up on shares over this next 6 to 12 months. But when does it actually start to go up? Do we have to wait till 2027 for it to go up, or 2028 or 2029? Here's the deal on exactly when Salesforce will start to go up. Salesforce has a product they launched in the past year, Agentforce. Now, this is supposed to be Salesforce's next big product. Wall Street's not convinced that this product is the product yet. Once Wall Street becomes confident that this is a banger product, you will begin to see Salesforce stock go up dramatically. Not a small amount, dramatically. But they've got to become confident that Agentforce is the next level of growth for Salesforce. But here's the thing, ladies and gentlemen. We already have some proof in regards to this. Let me show you this, and this is important for you to understand this next point I'm about to make in regards to finding the next great opportunities in the market as well. Look at this. What I'm showing you right now is Salesforce revenue growth percentage per quarter over the last number of quarters, okay? Now, what you're going to find is a company had clear deceleration of revenue growth going on. They went from 11.2% revenue growth down to 10.7, down to 10.74, down to 8.39, down to 8.3, all the way down to 7.6. Then they flattened out. 7.6, then 7.62. Latest quarter came in almost 10% revenue growth. The inflection has already happened in Salesforce. This is a big moment for a company. When you have a company go from the growth keeps decelerating to then flatlining, to then going back up, you're at an inflection point in the business, and there's something fundamentally changing for the better with the business model. And so Wall Street's behind the curve in regards to Salesforce. They should already be buying the stock aggressively. They're waiting until like 100% convinced of Agentforce. And I'm like, they already need to be buying now. They need to be buying Salesforce right now. They can't wait until all of a sudden revenue growth goes to 11, 12, 13, 14%. They wait till then. They waited way too long. They need to be buying right now during this period. And so Wall Street's behind the curve. It's not the first time. It won't be the last time. They're always behind the curve, right? That's Wall Street for you. And so at the end of the day, Salesforce, in my opinion, is one of the best buys right now in the SaaS space, right? It's got one of the lowest risk profiles I can find in the market. It's got one of the highest reward potentials, right? And this comes from somebody that was an aggressive buyer of Palantir stock and made a fortune of money on Palantir stock, right? Treated me phenomenal. But Palantir comes with massive risk at this point in time. The massive risk in regards to Palantir is as soon as that revenue growth starts to decelerate, the stock's going to get absolutely obliterated. Not like, oh, it's going down a few percent. No, it's going to get obliterated. And the question is that next quarter? Is it the following quarter? Is it the following quarter? And Palantir comes with not a lot of upside because the valuation's gone so insane. The forward P on Palantir is like 300. The 2-year forward P on Palantir is like 200. So there's not a lot of upside potential left for Palantir, right? And the downside risk is significant as soon as that growth rate starts to decelerate, given where the valuation's at. So if I had to go Palantir or Salesforce over the next month or 2 months, who knows? Like, I wouldn't be surprised if Palantir outperformed for the next 1 to 2 months. But over the next 4 years, there's not even a question. Salesforce will dominate Palantir over the next 4 years, essentially, in regards to risk reward profile there, right? And then Palantir will go through a crash at some point in time. Once those revenue growth starts to decelerate, it'll go through a crash, and it'll be a phenomenal time to then buy Palantir again, right? And so, there was past times that it made sense to buy Salesforce over a stock like Palantir. Salesforce had a better risk reward profile. And then there was times where it was better to buy Palantir over Salesforce. For instance, 2022, you got to buy Palantir at what? $6 a share, $7 a share, $8 a share, $9 a share. Like, easy peasy lemon squeezy, at least from my perspective on that, right? And you got to make fortunes of money. Right now is not that time, right? Now's the time to look at a stock like Salesforce over a stock like Palantir. And I wouldn't even mind cashing the rest. I'm holding Palantir for now just in case revenue growth went to like 70 or 80% or some insane number that I don't foresee happening. But if it did happen, I'm holding some shares for right now. But I wouldn't mind swapping out the rest of my Palantir for Salesforce at this point in time. Because I'm playing this game for the next 4 to 5 years, not for the next, 4 to 5 days or the next 4 to 5 weeks or something like that, right? Alrighty, next one up here. Let's talk about the 3 grade A stocks everyone must own, okay? First one of these 3 is this one. AMD. AMD's a beast. It's a must-own stock at this point in time. Everyone's got to own this stock. The levels of growth here that this company is going to start to report is going to be phenomenal, right? Now, in regards to that growth, right? Obviously we've had this initial move in regards to AMD, right? And it's been beautiful, and congratulations to everybody that's made some money. I hope you made a whole lot of money in AMD so far, right? It's been beautiful. But keep in mind, this is just the beginning. How is it just the beginning? If you look at analyst estimates, right? Now we're looking at 1000xstocks.com. We're compiling what analysts are expecting for this company as far as revenue growth goes. 28% next year, revenue growth 20%. Where are they getting these numbers? I'm like, analysts are crazy clueless. If you look at almost all these analyst projections, they're projecting revenue growth. I mean, I've seen some lower in the 15 range. I've seen some like in the 20s. I don't know where they're getting. I don't know if they're even paying attention to what's going on with AMD. I'm going to be completely honest with you guys, because this company's going to way outgrow these sorts of numbers. Look at this. I'm showing you now on a quarterly basis. So the quarter they're about to report here in the next few weeks, analysts have them only growing revenue 28%. Keep in mind, this quarter is actually going to start having the 355 numbers in there. This is huge for AMD, right? The next quarter is going to have 355 numbers, and the next quarter as well. Them only do 19 and 19% revenue growth. And the other parts of their business are also inflecting better now at this point in time. So I don't know what analysts are up to here, or this is crazy to me. Come on, analysts! Holy smokers, that's no dang jokers, right? Now, additionally, analysts, even in some of these quarters, when they're going to start to have the 400 series hit the numbers, right? Like right here, they have them doing 35% revenue growth, 45% revenue growth, 46% here. They basically, analysts' best case is some quarters are going to maybe go into the 30s and 40s, right? Here's the deal. If you look at Nvidia, when they were going through their major first couple years of their growth cycle, right? AMD's just finally this next quarter they're about to report is just AMD's first foot into the AI opportunity, and then it's just going to get more extreme over the next 2 years, essentially, right? But if you look at what Nvidia was reporting for revenue growth numbers, 101%, 205%, 265%, 262%, 122%, 93%, 77%, 69%, and even the latest quarter, 55% revenue growth, well deep into the AI cycle. In the best case scenario for any quarter coming up in the next number of quarters is 40-something% revenue growth. What are they doing? What are these analysts doing? Are they not paying attention? Come on, man. We already have a model built here to show us rough revenue growth rates, right? Now, you might think, AMD is not getting to 265% growth. They're not getting to 262. Nvidia is a 101, right? You're going to tell me they're not going to get to 55% revenue growth for some of these quarters? You're going to tell me for some of these quarters they're not going to get to 60 or 70%? I think that's very doable. I think it's debatable if they're ever going to get to 265% revenue growth. I don't think it's that debatable that they could get to these sorts of numbers at least, right? And so analysts are way, way too bearish on this, right? And while I was actually prepping this video, I had Fast Money on my phone and Dan Nathan talking down AMD, talking up Nvidia, making bad points in my opinion. I always like it when I go against the stock Dan Nathan's against. I always feel good about that. But and it just goes to kind of these Wall Streeters still haven't woken up to the massive opportunity here that is an AMD stock. They have not woken up to that opportunity, and it's right in front of them, right? So the next 24 months, AMD stock, where do I see it going? I believe 400's in the bag for AMD now at this point in time in the next 24 months. I think it's a coin flip if the stock's going 500 plus in the next 24 months. It's a 50-50, I would put it. And if I had to put odds on it, I live in Vegas, we put odds on everything. The odds that this stock could actually go 1,000 plus in the next 24 months, it actually has a chance. It's a low probability in my opinion. I'd put it at about 10% odds, but it is a chance. If they no one is prepared for AMD if this company starts to report revenue growth rates of 50+%. No one is prepared for that. No one. No one's talking about it. None of these Wall Streeters are talking about it. None of these fund managers are talking about it. If all of a sudden, next thing you know, in the next year or two, AMD starts coming through with 50% plus revenue growth rates, Wall Street's going to lose their mind. What happens if AMD starts to grow 70%, 90%? Or what happens if they get to Nvidia type numbers, 200%? I'm not banking on that. But what if it happened? No one's ready for this, man. No one's ready for this. And so when you look at AMD, you're like, could there be a lot more opportunity here? The answer is absolutely, okay? Alrighty, next stock up here. The second stock, these three grade A stocks, that is a great buy. Amazon, amazing's on. This is the second one of these three. Before I go into Amazon, right, and this is a position that's very important to me in the public count. I'm up $116,000 on it so far. Listen, man, before I go into the numbers, before I show you my bull case, bear case, base case for Amazon over the next number of years, where the stock's go and all that sort of stuff, listen, just get back to yourself. Think about how much money you have spent on Amazon over the last 5-10 years. Think about how much money you're going to spend on Amazon over the next 5 to 10 years. Think about how much money your friends and your family members are going to spend on Amazon over the next 5, 10, 15, 20 years. Think about how much money all the businesses and companies that use AWS that you use AWS as their backend, right? And their cloud provider, and how much money Amazon makes off of all those folks. Like, just think about all this for a moment. And owning Amazon stocks is actually a great chance to give back to yourself. It's like, credit cards do cash back or whatever. Like, this is like a cash back situation, right? You spend $5,000 a year on Amazon. Great. You own a lot of Amazon shares. You probably hopefully made more than $5,000 back on that. You spend $2,000 on Amazon, products you buy on Amazon a year. Hopefully you make a lot more than $2,000 a year on Amazon stock, right? So it's a chance to get back to yourself when you own Amazon stock. Now, I posted this on X here today. People are complaining about Amazon and X. I'm like, what are people complaining about? So people are complaining about Amazon today. No clue why. Amazon's one of the easiest buys in the stock market. Low risk and high reward the next 5 years. Buy and don't stop buying Amazon stock. Yeah, I'm up 6 figures on Amazon stock. Just in the public count, never mind private portfolios, right? I'm still actively buying Amazon stock right now. That speaks volumes. As not often I'll make 6 figures plus on stock and I'll be like, still need to be loading, and where I'll still be buying that stock actively. That very rarely happens. You got to be a special company to do that. Okay. Now, here's a deal with Amazon. The stock trades way too cheap right now. You look at a forward P on the stock at 31, right? Keep in mind, this is probably that 31's actually probably a lot lower. Okay. But you compare it to somebody like an Apple, another peer company, one of the biggest companies in the world, right? Apple trades at a 33 forward P. So higher than Amazon, but the difference is Amazon's a company you can count on growing double-digit percentages each year. Apple, you cannot count on that. Analysts have them growing revenues this year 8%, next year, or current year expected revenue growth about 8%, and next year about 5.5% for Apple, right? So no question, if you compare Amazon versus Apple, like Amazon's a way better buy, right? But remember, I talked about this number is actually probably lower. It's probably they're probably trading at a forward P right now, like 25, 27, 28, something like that, not actually 31. And here's why. We're going all the way back to the beginning of 2023. Look at every single quarter, and what do you see? Monumental beats in the earnings per share. Every quarter, they beat 10 cents here, 31 cents here, 35 cents, 20 cents, 15 cents, 24 cents, 29 cents, 38 cents, 23 cents, 30. These aren't like, they beat by a penny or a few pennies. No, they're knocking out of the ballpark every quarter. So when I show you Amazon's trading at a 31 forward P right now, understand it's probably like a 27 in reality. Because my guess is over this next year, the company's going to come in and smashing all its estimates, right? So the stocks trade the 2-year forward P is probably the actual forward P in my opinion. And the 2-year forward P on Amazon's probably 22. It's probably a do-si-do in regards to this one, which for a company growing top line and bottom line double-digit percentage, come on, man. That's a little bit of a joke there. So what's my bull case, base case, bear case for Amazon? Okay, so my bull case for Amazon, 14% revenue growth per year, 2026 to 2029, 20% net income growth for the company. Net income should grow at a much faster clip than revenue for Amazon. And a huge reason of that is not only AWS and the profitability there, but the ads business. The ads business is starting to become substantial for Amazon, and that, we know the big money's in ads, right? Ask Google, ask Meta, like that's straight profit. So I have been getting to 12% net income margins come 2029, 35 to 40 PE under a bull case where, mid-teens revenue growth and 20% net income growth. 35 to 40 would be very fair. Gives me a compounding annual growth rate of 23 to 27%. And the stock should be somewhere between, let's call it about $500 and maybe $560 in this sort of bull case scenario. But what about my base case? What about what I actually expect for Amazon? Here it is. My base case for a company, 12% revenue growth per year over the next 4 years, right? 26 to 29, 18% net income growth, Once again, get to my 12% net income margins come 2029, 33 to 38 Ps, fair for a company growing low double-digit revenue, and let's call it high teens net income growth. $433 stock to maybe a $500 stock, and a compound annual growth rate of 20%. You give me a CAGR of 20%, I got to take it. I can't just sit on my hands in that situation. I got to take that opportunity. And that's my base case for Amazon. It's nothing crazy. Like, you just look at the numbers. Is it crazy to assume Amazon will grow 12% revenues per year? No, that's nothing crazy about that, right? No, my bear case for Amazon has them only grown revenue 10% per year, which that I don't know how they would only grow 10%. When you think about Amazon Prime, be able to go up on price on that from time to time. When you think about the e-commerce business continue to grow, when you think about AWS continue to grow, when you think about the ads business continue to grow, it's almost impossible for me to imagine Amazon only growing 10% per year over the next 4 years. But for my bear case, I did it. Okay. 15% net income growth per year would be horrible for the company. 30 to 35 Ps, very fair for a company growing top line 10%, bottom line 15%. I get a CAGR of 13 to 18%. If I'm not going to lose money on a stock over the next 4 to 5 years, under my bear case assumption, and not only that, but I'm going to outperform the S&P 500, buy and don't stop buying. Give me every share in sight of that stock. Every share in sight, right? Now, here's the next important thing. And by the way, Amazon's on the way to becoming a $1 trillion revenue company. Under my bear case, Amazon eclipses $1 trillion plus in revenue in 2029. Under my base case, they reach $1 trillion of revenue in 2028. And also in my bull case, they reach $1 trillion of revenue in 2028 for the first time. So it's going to either be 2028 or 2029. This company's going to be doing $1 trillion plus of revenue. Incredible, right? But here's the thing you got to understand about just the e-commerce business. Keep in mind, the AWS business, ads business, those are straight profit. Those are massive businesses in revenue terms as well, but they're straight profit businesses. But if you're wondering where Amazon's revenue is going over time, you got to understand how commerce goes over time, okay? So Walmart, if you look at Walmart, back in 1995, and you would have thought Walmart already had locations everywhere. They could have locations, right? Like, can Walmart even get that much bigger? Walmart was doing $106 billion of revenue back in 1995. They're going to do about $700 billion over the next year. $700 billion of revenue from $106 billion. If you look at Costco in 1995 was doing $20 billion of revenue. They're already a giant. They're going to do 260 plus, right? 260 plus in revenue, way over a 10x. Right? Why do these sorts of companies continue to grow so massively even when they're huge, right? Like, why is Amazon, Amazon's about to go to $1 trillion in general company revenue wise, but I think by sometime in the early 2030s, the company's going to be doing $1 trillion plus just on the e-commerce side of the business. But why? Well, one, you take market share over time if you're a dominant retailer, and that's what Amazon does, right? Two, everything gets more expensive. And so imagine going into a Walmart in 1995. Everything was dramatically cheaper than it is today. If you go into that same Walmart in 2025, right? Go into a Costco and go buy a big bunch of toilet paper in 1995 and go do that same exact thing today. It's massively more expensive. So the revenues go up over time, the profits go up over time, as long as the profit margin can stay the same, right? Because if you sell something for $1 and you got a 50% profit margin on that, you make 50 cents of profit. You sell something for $10 and you get a 50% profit margin on that, you make how much? $5. It's beautiful. Isn't that beautiful? It's a beautiful, man. It's a beautiful thing. Okay. So moral of the story is buy Amazon. Don't stop buying that stock. That's just the greatest gift of an easy money stock. Okay. Alrighty, folks. Number 3 of these grade A stocks, they all begin with A. And then, so if you're wondering why am I calling them grade A stocks, grade A income statements, grade A balance sheets, and they all start with an A. Okay. But this one's controversial, and it shouldn't be controversial, but it is a controversial stock out of these 3. It's probably the most controversial. You know what it is? It's Adobe. This stock has been awful the past year, down 34%. And this could be another tax loss harvesting stock over the next 2 months. So watch out. Like, this one could continue to sell off short term, right? Because people are, my guess is funds, everybody that's bought Adobe stocks basically sitting on massive losses. Like, if you bought Adobe stock at any point in the past many years, you're sitting on massive losses. So that's a lot of individual investors, and that's a lot of funds That's a lot of investment funds, right? Now, when it comes to Adobe, you look at their latest quarter, like business is phenomenal. Like they had 10% year over year revenue growth on a constant currency basis. They had 14% non-GAAP EPS increase. Like this is phenomenal. Like there's nothing to be ashamed of here, right? Very impressive numbers for the company. Now, in regards to everybody that uses it, right? Business professionals, consumers, creatives, marketing professionals, and things like that, right? The big worry about Adobe is they're being disrupted right now because of ChatGPT, Google Gemini, all these other products out there, right? That maybe can make images for you, videos like that and things like that. And you've seen some of the like teaser videos and like the hype videos around these ChatGPT and Google and things like that. And it's like, oh, that looks good. Those images look good. Those videos look good. Listen, I've been testing these products and it's just crap, man. It's like generic AI slop, I call it. Okay. At the end of the day, if you need to make a great image for your company or business or a piece of creative content, listen, you got to use Adobe's products still, right? Or something that is similar to Adobe's products. You can't just rely on AI. You can't say to ChatGPT, please make me a blah, 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 blah. No. It's going to do a far worse job than what somebody that's good in this field would do. I mean, even somebody that's bad in this field might do better than these AI products as far as all that goes right now. Like if I need to make a new web page design, like you still need a professional to do that. And everything across the board, images, videos, all that sort of stuff. So like the products are cool that are out there, but you still need an actual human to really do this stuff on a high level. Otherwise, it just comes across as like generic AI slop and it's not at a high level. So the whole worry about like, oh, Adobe's doomed. I just don't think those people that are calling it are actually in this field and actually testing these products out, right? So something to keep in mind there. What about my bull case, base case, bear case for Adobe? So my bull case for Adobe has them only doing 10% revenue growth per year over the next 4 years. That's my bull case. Think about it. I'm doing 10% revenue growth for a bull case for Adobe. It's nothing crazy, right? Net income growth at 12% for the company. 25 to 30p would be very fair for a company growing 10% top line, 12% bottom line. That gives me a CAGR well into the 20s off of a little 10% revenue growth per year. That's a pretty attractive stock, right? Here's my base case. This is what I actually expect for Adobe. I expect them to only do 8% revenue growth per year over the next number of years. Very conservative. 10% net income growth on average over the coming years. 23 to 28p is pretty fair for Adobe in that situation. Gives me a CAGR of 16 to 22%. These are very modest expectations I have for Adobe. And I still get great CAGRs, right? Now, if they can amp it up a little bit, we're talking things will be much better. My bear case for the stock, I am only doing 2% revenue growth. This would be brutal, and 2% net income growth. And in that sort of situation, I would lose a little bit of money over the next few years, right? So at the end of the day, like when I run my Adobe numbers, like the stock's a buy, right? I can make an argument that AMD and Amazon are better buys, right? But at the end of the day, like, you know, if you want to be diversified here, and keep in mind, if Adobe has better growth rates than what I have here, my base case is at 8%, that CAGR will move up significantly. If they actually do 10 or 12 or 14% revenue growth per year, right? Let's say they knock it out of the ballpark with their products and services over the next few years, they're able to continue to go up on current customers. Like we could be talking about the CAGR is actually well into the 20s, if not the 30s over the next few years. So just something to keep in mind in regards to Adobe. But look at the charts feature on 1000X for Adobe. If you had to tell me, show me a perfect stock, Jeremy, I would show you Adobe. Look at the revenue. This is where their revenues trended. This is where their revenues expected to trend. That's perfection. Look at the gross margins of the company. Look at the net margins of the company. This is perfection, ladies and gentlemen. Look at the earnings per share, where it's gone and where it's going over the next over the next 12 months. Unbelievable. Look at the free cash flow on a trailing 12-month basis and where that's trended. Look at the operating cash flow and where that's trended. Look at the operating income and where that's trended. Look at the shares outstanding going down, 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 down. That's exactly what you want to see as a shareholder. Like, I don't know what to say other than Adobe is one of the most perfect stocks you could ever see. And so unless they actually end up being massively disrupted, until that day, like this is one of the most perfect stocks literally in the market. Just numbers basis, right? Now, I want to leave you with this here. I posted this on X 3 days ago. If you don't follow me on X, it's always linked in the description area of all my videos. By the way, I post quite a bit on there, including several posts today. So let's start preparing for 2026. Fireworks here at the end of 2025, but we need to already be onto 26 mentally. We must grow our wealth every year despite market conditions. Not always easy to do, and that is fine. We don't mind putting in the work. We can grow in 2026. That's sort of no prisoners approach we have to take to the market. We're going to grow regardless of Trump, tariffs, Besant, Fed, blah, blah, blah. We're growing. We're growing our wealth every year regardless, okay? And if you like to put in the work, all that good stuff, join my private stock group, get access to all the course curriculums, get everything that I have up here downloaded to your brain. And once again, if you have less than $100,000, you better get in there ASAP because, obviously, we're making changes starting in January 1st, okay? Let me ask you a question. Do you know how to identify when a stock market is drowning and it's fighting for its life versus a stock market that's doing very, very well and is very, very healthy? Well, I have something very interesting to show you here today because we have a stock market that is doing one of those things right now. And I'm going to show you exactly what's going on here, how to identify this in the future. We'll also talk about some stocks that I need to talk about at the front of this video as well. From there, we'll discuss a big move I'm making in my private group to let everybody know that. From there, I want to talk about the stock market of 2018. You've heard me reference 2018 many times over the past number of months. So I want to go ahead and talk about what the market did in 2018, how it's similar to what we're going through right now. From there, we're going to react to this video, Oracle to deploy 50,000 AMD chips. I'm looking forward to reacting to that one, sharing my opinions and perspectives there. Stacey Roskan, his views on the AI cycle, where we're at here in regards to this. And then Tom Lee went on CNBC, looking forward to reacting to everybody's favorite bull, Tom Lee. Appreciate y'all for joining me as always. Got a lot to go through in this video, so I just need to get straight into it. There's just one thing and one thing only I need from you guys before we do that. If you could please just hit the like button on this video. If you could just make that thumbs up button glow, you are my hero. Everyone that has already done that without even me asking, you're the best, okay? Additionally, if you enjoy my content, you want to see more of my videos in the future, make sure you're subscribed here to the channel. If you're subscribed, higher probability YouTube will show my videos to you in the future when you go on YouTube. If you aren't subscribed, lower probability. So make sure you're subscribed here to the channel if you enjoy my content. Alrighty, folks. So right off the bat, how do you identify a stock market that's drowning? Okay. Well, if we look at, for instance, the market over the past, I would say over the past year or two, what you would have is any time the stock market would try going down, it would seem in the last 30 minutes to last hour of trade, suddenly like the market would somehow go green, right? And it would be like, dang, that market looked like it was going to be red today. It looked like it was going to be Red Dead Redemption. Somehow we eked out a green day, right? And if you've been in the market, especially, or say over the past 6 to 12 months, like that's a lot of what we have gotten, right? But a thing finally happened here today that I've been waiting for this thing to happen because it's one of those things that usually when you start to get into more of a cautious bearish market, this is something you usually identify. And what we had here today is essentially the market was just rolling around, right? It was going up, going up. It was looking like, okay, we're going to eke out a green day here. And then in that last 30 minutes to hour, it just tanked. It just tanked, right? And that's what you have happen when you're starting to get into a more cautious, weaker market. People start getting more uncertain. They start wanting to take profits. They have profits on a day, right? Remember, the stock market's not made up of just people like me that are investing in stocks for the next many years. It's made up of a lot of traders getting in, getting out. These people want their money and they want it out, right? And so in the market, essentially, you have these certain time periods where all of a sudden, people are like, if I got a green day, I'm getting out of this thing because I don't want to hold till tomorrow because tomorrow we're probably going down, right? And so that becomes a viewpoint. And so this is a very important thing to kind of identify here when you start getting in the market like this. You're starting to get really, investors, traders in general are starting to get really cautious on the market when they're like, I don't even want to hold this thing overnight, right? I just, if I got a green day, I'm taking it right out. So that's a phenomenon we have going on right now, right? Now, looking out there, it definitely seems still like really uncertain. There's no panic. There's no panic in this market right now. There's no big fear in this market right now, but there is uncertainty. There is cautiousness. And you can see that in the way the indexes are starting to act, right? And additionally, you can see that even with things like crypto, right? Like Bitcoin is having trouble holding gains. Ethereum's having trouble holding gains. Like if it has some green momentum, it kind of sells right back off. So you have that going on. Oil's continuing to flounder. Oil at $58 here. That's screaming recession, right? There was even a lot of stocks that had trouble holding gains. AMD had great news today, great news, and it just couldn't hold it. It just couldn't hold. I mean, it still finished green. It finished 0.7%, but this stock should have been up easily, 3 to 5% today. And it just could not hold those gains. Everything that had bounced all the way to 224, almost 225, and then just sold right off to 217. If you look at Nvidia, same exact phenomenon happened today with countless of the big tech stocks, but Nvidia being the one that really comes to mind here, where it's just like, look at Nvidia. It opened low, it came back really strong, and then it just dropped, just straight down. So you have a lot of that going on. Salesforce continues to be weak in the short term. That one's a huge buy, in my opinion. Huge buy. I love that stock. I would love to buy every share in sight for the next, I would say, 6 months on Salesforce. I'm just going to continue to load. Don't be surprised if I buy that stock nearly week in and week out in this market. If we look at housing stocks here today, those ones all were nicely green, but man, those ones just, every time they get a green day, they get another 2 days of red followed up. So, although it's green today, like, don't be surprised if all of a sudden it's suddenly massively red tomorrow in regards to those. As far as my possible buys watch list here, for these ones, I have Planet on there. I have Salesforce. I have Amazon. I love Amazon here. I have Adobe. I have Nike. I have Google. I have RH. I have Bath and Body Works, Cheesecake, Cava, SoFi, Whirlpool. Some of these stocks I'm waiting to see if we get this downtrend like we had in 2016. If we get that, then that's when I'm going to go ahead and step in some of these stocks, like a Cava, for instance. Like if this market gets really weak, Cava's going $40, right? If this market gets really weak, Bath and Body Works is going do-si-do, 22. If this market gets really weak, RH is going 125, maybe even under 100 if it got really, really weak, right? So some of these I'm kind of like waiting on. A Whirlpool, if this market got really weak, Whirlpool could go 65. So some of these I'm not in a big rush. Like something like Google, I feel comfortable buying right now. Adobe, I feel like fine buying that one right now. Amazon, I feel fine buying that one right now. Salesforce, I'm jacked up to buy that one right now. Cheesecake, I'm fine to buy that one right now, right? But some of these other stocks, I'm like, we need more downward moves before I could say, you know what? Yeah, let's go ahead and let's buy some of these guys, okay? Now, before we get into 2018 and what happened in the market in 2018 and how it's kind of similar to what we're going through right now and how to understand this market over this next 2-3 months here, big change to the private group I need to let everybody know about, okay? So, effective January 1st, 2026, if you want to join the private group, you need to have a minimum net worth of $100,000. So that's something to keep in mind. That will be going into effect January 1st. So if you have less than $100,000 net worth, you have about 2 months roughly to get inside my private group. But once January 1st hits, you'll have to have $100K or more net worth to get in there. Okay. Now, what's going on here in regards to the market and what we're going through right now versus 2018? So I wanted to show you how the market acted in 2018 so everybody can understand this. Okay. So the first thing you got to understand is the market didn't just go straight down. Okay. It wasn't like, every day, every week, it was obvious like the market was going down. That caught a lot of people off guard, that market, that particular year, right? I just want to back this up for a 1 month here and maybe even over to a 5 day, because we recently had peaked in regards to this market here on the 10th. The 10th was a peak there, right? Yeah, 10th was a peak. So the interesting thing is in regards to the market and what happened here is you had an initial downdraft, right? And then you had a comeback, all to go lower. And what you had is a phenomenon called essentially lower highs and lower lows. Every time the low got even lower. Every time the market started calling back, the high was even lower, right? And so look at this. You had market goes there, market goes here. We go even lower, a lower low than the previous low, right? Then the market tries to come back, but it's a lower high than the previous high. Then we go even lower. We have a lower low than the previous low. Market tries to come back and it's a lower high than a lower low. And that phenomenon just continued all the way until it ended, which was right around roughly the day before Christmas, essentially. And so just understand this is the sort of market we could be in this next 2 to 2.5 months, where it has these moments where it looks like, okay, we're going to come back, but the back is not as good as the previous back was. And then it looks like, oh crap, we just busted through the lower low that we had just a week or 2 weeks ago, right? And so the overall trend goes against you, and it goes against the market and just continues to go lower and lower and lower. And that's easily what we could have happen over this next few months. There's no guarantee, but it easily could happen. And I think it's important everybody understands that this phenomenon, could easily go on here. And it doesn't mean every single day or week's going to go on. It's going to give you false hope. If you're hoping for the market to go up short term, it's going to give you false hope thinking, oh, okay, we're coming back, all to go lower, right? And this is just a great buying opportunity because you continue to get these market drops where as long as you're a buyer, you have cash, you're just loading up on shares left and right. And it's a beautiful thing, man, because you get these unbelievable deals. Okay, speaking about deals, Oracle to deploy 50,000 AMD chips. What's going on here?
Tech check. Our Seema Modi's live at Oracle's AI World Conference in Las Vegas. Morning, Seema.
Vegas, baby. I'm in Vegas.
Morning, Carl. Yeah, this is big news. Oracle will be deploying AMD's latest artificial intelligence chips to build out a new supercluster to help customers run larger, more complex AI models in the second half of next year. I spoke to a number of Oracle Cloud executives on why they decided to partner with AMD this time over Nvidia. And here's what they had to say about why they see AMD as the right choice for inference.
I think with AMD, we've been working for so long with them that their software stack is really, really critical. And we feel like customers are going to take up to AMD very, very well, especially in the inferencing space.
This is really intriguing, ladies and gentlemen. Listen. Oracle executive says AMD software stack is really critical. That's intriguing because if there's one weakness we've heard about AMD, it's the software stack. People will say, oh, Nvidia's got it all over them night and day. And, that's a fair argument to be made. But the fact that an Oracle executive comes out and says that, I think it's very, very bullish for AMD overall, like very, very bullish. And I think not a lot of people have respected AMD when it comes to the whole systems and not just being a chip.
Now, this is a vote of confidence for AMD. You're seeing shares move higher right now, whereas Nvidia is trading lower. AMD is increasingly being seen by the marketplace as a viable competitor for inference. It does follow that news last week that OpenAI would be taking that 10% stake in Advanced Micro Devices. Now, for Oracle, buying thousands of chips, hundreds of thousands of chips, is a huge bet, as we know, for founder and chairman Larry Ellison, who is here. He's here in Vegas at the conference, and he will be speaking on stage very soon. Ellison is expected to provide more details on that $300 billion deal with OpenAI and how it is fundamentally changing how Oracle is investing and what it will take for the software giant to remain competitive with the likes of Microsoft, Amazon, and Google. He's also expected to expand on Oracle's new suite of cloud offerings that executives tell me will make their cloud computing platform more efficient and faster for their customers. And then there's Thursday, Carl. Well, we will find out how exactly Oracle will fund these massive purchases of chips. That's when the company's financial analyst day kicks off. So a lot riding on this week.
Okay, thank you, Seema. Always pay attention when Larry Ellison speaks. Seema Modi.
So it's always fun to hear, these, folks on CNBC or whoever ask these companies like, well, are you going with AMD over Nvidia, right? First off, Nvidia, you might not even be able to get all their chips because they have such an insane amount of demand, right? So there's something to keep in mind there. You might have to be on a backlog, a long wait time. Additionally, when it comes to Nvidia, you're paying ridiculous pricing. So AMD is able to come on with a product comparable to Nvidia, but ultimately, I would never call AMD's chips better than Nvidia, but they're very comparable in terms of this next series. The 355X series is impressive, but obviously the 400 series is going to be knock the doors off. And that's going to be directly comparable to what NVIDIA is putting out there in the marketplace from everything I understand about this. And so you got to think about it in terms of all these big tech companies want AMD because AMD is going to be able to give you a comparable product at a much cheaper price. And at the end of the day, with how much these companies are starting to spend, they're starting to realize they don't have a lot left to really up those budgets in future years. They've upped these budgets such an insane amount. So much of their cash flow is going just basically to NVIDIA's pocket that at the end of the day, they're going to have to figure out something here because it's not like they don't want to continue to order infrastructure and continue to order these chips and these systems, but they would like to be able to do it with something that's insanely high end, but it's much cheaper. And that's where AMD comes in. And so that's why I always tell you guys, NVIDIA is AMD's best friend. AMD is not NVIDIA's best friend. Let me be very crystal clear about that. But NVIDIA is AMD's best friend. And the reason being is NVIDIA has shown the way, the pricing, the insane pricing, right? And AMD is able to say, okay, we're going to come in with chips comparable to what you guys have, but we're going to be able to offer at a lot cheaper price and still make ridiculous margins that AMD's never seen before. And so get ready for AMD's gross margins, net margins to absolutely explode over the next 2 to 3 years to levels that we've never seen in that company's history, just to be quite frank, right? But it's not, AMD's not NVIDIA's best friend. I can tell Jensen is defensive on this subject. I've seen him be asked about it a few times over the last couple of weeks. He's definitely defensive. I can tell in his tonality, his word choice, he doesn't like it. AMD is not NVIDIA's friend, but I can tell you NVIDIA is AMD's best friend. It's crazy, man. Crazy, crazy. So, I mean, it's even funny. NVIDIA is saying they're going to announce and invest into OpenAI, but then OpenAI says, hey, we're actually going to invest into AMD, right? And get, or at least get shares of AMD and spend a bunch of this cash on AMD chips. Imagine being NVIDIA. Imagine being NVIDIA, giving your money to OpenAI, and then OpenAI says we're going to go spend a fortune over the next number of years on AMD chips. I'd feel a little jaded if I was Jensen. Wait a minute. I'm going to give you guys a bunch of money, and I've been giving you guys preference for all these high-end chips, and this is how you're going to repay me? You're going to go buy those AMD chips? But you know, it is what it is. So it's fascinating in regards to how that whole market's evolving. So how do I feel as an AMD shareholder? Do I feel like I'm ready to start cashing some shares? Oh, heck no. Oh, heck no. No, thank you. Okay. I understand there's a lot of volatility in the market. The market could downtrend easily over this next 2-3 months, maybe. And if that happens and AMD goes down a bit, like, that's fine. It's just another huge buying opportunity. Like AMD in the next bull cycle, don't be surprised if that goes $300-$400, maybe even $500.
Semiconductor managing director and a senior analyst. And I don't know if you were ever wondering why'd I get into this area of finance, but God, the last, couple of years, this is where it's at, Stacey. It's hard to even keep track.
Unbelievable. It's certainly been a ride.
I mean, it used to be, you remember memory? It used to bore you to death. I guess there were those, we used to call them field FPGAs, field programmable Gatorade, we called it, where you could pick orange. Yeah. You could get grape if you wanted, if you're out on the field. But they were gate arrays. Then graphics chips and CPUs. But now AI changed everything. And I don't even know. I mean, I need to go back to school to really understand it. Did you do that? Some remedial work?
Well, you know, it's my graduate work in semis is probably 20 years out of date at this point. But we've been here and there on it. Yeah.
So AMD eclipses Intel. Intel's got some government help and maybe inducing some private companies to get involved, or they're public. But I mean, it's how do you navigate it at this point? What are your favorites?
Yeah, it's been pretty wild, right? And you're right. We've got winners and losers like massively changing place, and we've got government investment, if you maybe want to call it government interference, but that's there, and a lot of crosstalk between a lot of the companies, especially in the AI ecosystem. There's a lot of cross investments and things like that where it's sort of tying them all together. They'll all sink or swim, I guess, in one piece at some point. In terms of what we like, my general call this year has mostly been own the high quality AI names and ignore most of the rest. And by and large, like that's kind of worked. Like we've liked Nvidia, we've liked Broadcom. I still think that the AI cycle, I think we're still early. I think it's still got legs, and all of these new deals that we've been seeing announced, they actually, I think, have the effect of extending it even longer. Most of these don't even start to ship until the end of next year. So if you're worried about air pockets or digestion or anything like that, it's clearly not this year. It doesn't seem like it's next year. And if these big projects don't even start to ship until the end of next year, it's probably not 2027 either. I think we've got some runway on this still. So we still like those high quality AI names.
Hey, Stacey, we have Jared Bernstein joining us in, I don't know, maybe 20 minutes. And he has an op-ed out that says he thinks it's time to call the third bubble of our century the AI bubble. He says in financial markets, a bubble occurs when the level of investment in an asset becomes persistently detached from the amount of profit that asset could plausibly generate. Why do you think?
Before we go on to AI bubble and that sort of things, did you know something I just noticed? This is big. Stacey Rascon still refused to mention AMD, right? This man has been, he's supposed to be a semiconductor expert, but he's been so negative on AMD, right? Including, I think it was in the last 6 to 9 months or so. I remember I reacted to a video with Stacey Rascon basically saying, I don't even know if we need AMD. Whoa. I said, that's ridiculous. Such a silly statement. Such a ridiculous statement. And that's got to be a big pie in his face, does it not? Now you got every single one of the most important tech companies in the world wanting to load up on AMD chips next year. Whew. And imagine you're the guy that says, I don't even know if we need them anymore. It's embarrassing. It's embarrassing, right? And so Stacey Rascon just, missed it in regards to AMD. But not only missed it, it's one thing if you miss it, it's another thing if you disrespect it, right? And I feel like he really disrespected Lisa Su and AMD by saying, by that day when he went on and said, I don't even know if we need them. What are you talking about?
Well, I mean, it's certainly a concern that people do have. I think there's a few things and I think it really is that question on profitability. There's no question on demand right now, right? Nobody can get enough. That's the one sort of overarching theme that we're hearing from everybody in the space is demand for compute is off the charts. It's not like the tech bubble maybe where, we have dark fiber sitting in the ground today, from 2000, 2001. Fiber that was installed and never used. Everything is getting used. Like nobody's buying GPUs and sticking them on a shelf in a warehouse somewhere. Like they are all getting deployed and getting used and they can't get enough. So it really is that question on profitability and the revenue that this can drive. And I guess you could compare it. You could make the argument that the revenue will never be there. At the same time, though, it's still early in this. And you can look at other build-outs. Like you can look at, the build-out of AWS back in the days. That required heavy investment. And it wasn't profitable at the first. And nothing's profitable when you're on the early phase of the ramp.
OpenAI says it needs at least $1 trillion to invest in data centers that provide the electricity, computing power, and storage unit. But they've only got $13 billion in profits this year, in revenues this year, not in profits.
Now, but again, we're early and we're in ramp phase. So that becomes the question: can they actually drive revenue? Is this actually going to be something that is completely ubiquitous, or is it not? And I think time will tell. We'll have to see. I tend to be more on the bullish side of AI. I actually do think the demand is there, and I think there's enough, effort chasing this we're already seeing evidence, frankly, of at least on the enterprise side of returns. Like it's early, like it's in the experimental phase. But we're seeing evidence on the enterprise side. And then on the hyperscale side, I think there's already getting returns on this. You have to remember the folks that are building this stuff out, and this is one other difference maybe from, say 2000, 2001. The companies that are doing the bulk of the spending are some of the most well-funded and most profitable businesses that humanity has ever developed. And they're not idiots, right? And they can see things that we can't. And they've also got other businesses that they're running this stuff through that they're already getting returns on. Google's getting returns on the stuff. Meta is getting returns.
That sounds like it's different this time, though. But some of the circular financing and some of the companies that are in these weird incestuous relationships with each other where they're each dependent on the other for it reminds me a little bit. Remember the mergers back in the .com that you would exchange two overpriced cats for one overpriced dog and none of the stock was real, so none of the valuations were real. I don't know if any of that's similar, but even yesterday Pat Gelsinger said there's no doubt we're in some type of bubble, not one that's ready to pop. And maybe, everyone points to Nvidia's valuation is not anywhere near stratospheric. In terms of the multiple to earnings or sales, it's not so bad.
Maybe. Look, so I'm not sure Gel's ability to speak on this, frankly, but that's neither here nor there. Like we'll
I hear you.
Okay. In terms of some of these like quote unquote circular range, look. So the biggie was Nvidia, right? And that $100 billion number kind of raised eyebrows. Remember, it's not $100 billion right away. It's $10 billion. It's actually at first. It's actually stayed just with the So I think that's good. And look, like Nvidia doesn't have anything else to do with their cash, right? They're generating hundreds of billions of dollars of free cash flow, right? They can't do M&A. They have a dividend and a buyback, but relative to their market cap, it's tiny. So like I'm hard pressed to think of anything better that they could do with that cash than to grow and support the overall AI ecosystem. And the money's not going into the ether. Like they're getting what will presumably be valuable OpenAI stock. Like I guess at that point. And you have to remember, even with that $100 billion, assuming they deploy it, OpenAI is going to need a lot more money than that. Like they're not going to be the only investors in there by a mile.
So I think a big mistake OpenAI has made, in my personal opinion, is telegraphing like, oh, we need to spend $1 trillion and all this stuff. Like, if anything, that's going to freak investors out. You know, I'm talking about people that are buying into OpenAI, you know, in the private market over the coming years, because they're going to be like, oh gosh, like, especially if the market gets a little rough, then they're going to be like, question, like, is this worth investing into? Because they can still spend so much. I'm probably going to be diluted so much over the coming years, right? So that's something definitely to factor in my opinion. So the spend in the space is going to continue to be aggressive for the next several years. But the increased percentage is going to start to really be contracted. And if some of these stocks start to get hit a little bit, their revenue growth go down a little bit, like even talking big tech, it could actually see even a bigger wave to AMD because they're the value play in the space. You still want great performing systems, but you want it at a value. Like, there you go.
Global Advisors and Fund Strat Capital CIO. Tom, just summarizing what your thoughts are this morning. I don't see a whole lot that has shaken your confidence that the market's headed up. You still see 7,000 on the S&P by year end. You do point out it's not cheap, up 36% since the April lows. You do outline some headwinds, but I think you're outlining more positives than negatives for the markets, even right now.
Yeah, in fact, I think JP Morgan's announcement today really ties into why investors should stay pretty constructive on the U.S. I mean, JP Morgan, the biggest and the most powerful bank in the world, is investing $1.5 trillion into the U.S., into things that are going to strengthen sort of U.S. advantages, you know, critically important areas. And at a time when the U.S. is dominating AI, and of course now we have this big tailwind as blockchain is an initiative that Wall Street is building products on. So I think there's a lot of reasons for investors to stay optimistic. And I know there's a lot of talk about bubbles, but I think the thing I would just continue to point out is Nvidia trades at around 27 times forward earnings. It's still on a PE basis cheaper than Walmart and Costco, which trade at around 47 and 34 times forward earnings.
Yeah, you've got.
So I spoke about this. He's mentioned this 27 times on Nvidia, but it looks like he's talking about a 2-year out forward piece. So that's something to keep in mind.
Positive.
Because Nvidia still needs to finish up their fiscal year, then go through another fiscal year, and then we can talk about that 27 forward P.
Reasons to think that earnings are going to do well in a time when interest rates are coming down. So that's just like an elixir for stocks that is very powerful.
That's right. And as you know, CEOs have not been that confident for the last 2.5 years because the Fed's been running tight monetary policy. The ISM's been below 50 for 31 months now. That's the longest stretch in history. I think the sell-off Friday is giving us a bit of a gift because that surge in the VIX, a 32% rise, is the 39th highest ever one-day surge. And the 1-month median return is almost 3%. Of the 38 other instances. So I think the S&P could add, 200 points between today and mid-November.
Still got, we're not overly positive in terms of sentiment right now. So that's not late cycle, according to you, at this point. And still a hated rally, $7 trillion on the sidelines if people decide they want to go into stocks.
Yeah, I think conviction is a measure of whether or not the market is, pricing in too much good news. I think with Friday's sell-off, I saw many people calling the top of the markets or declaring that the bubble is bursting or that, this is the reason to be buying gold. And if investors are that quick to call a top just on a 2.7% decline. I just think a lot of good news isn't really priced in. I think there's still a lot of reluctant investors on the sidelines.
You have found a kind of everything's about crypto. You found a reason gold's up, and it's because of crypto. Not directly because of crypto, but you think the incremental buyer in gold there's gold-based stable coins, and people need to buy gold to back the stable coins. And that, do you think that's enough to be up $92 all the way up to a new high?
Well, there is an interesting correlation we found, which is when I look at Tether's supply of dollars outstanding, it really started to rise about 3 months ago. And that corresponded with gold essentially going up every day. I'm not positive of this, but I think stablecoins, including Tether, may be one of the largest buyers of gold today.
That's perfect. So the people that have been bullish on gold for so long and bearish on crypto and Bitcoin, they're finally getting their big rally in gold, and it's because of the thing they hate so much, crypto and Bitcoin.
Yeah, that's right.
That's so funny.
Tether is proving to be a good meeting ground between Bitcoiners and gold people.
Tom, can you just explain, though, to the extent we can understand it, within at least the Bitcoin world, just how much leverage there is in that system? Because I think one of the things that we were looking at Friday was the possibility, at least, that some of that selling, or maybe even a lot of that selling, came from margin calls at that time.
Andrew, there's always been a lot of leverage in crypto. I think that the volatility and leverage is what has drawn people into that space, especially when you get outside of Bitcoin and Ethereum. Those two are generally not held on margin. I mean, there is some leverage with what they call perpetuals, but that's why they held up so well over the weekend. But this liquidation that was triggered over the last 3 days, the estimates are at least 19 billion of liquidations, but it's probably understated. It might be 4 times bigger. It's the largest since 2021. Essentially, you have to go back to FTX. I think there is a lot of leverage in the way people use this product called perpetuals, which is trading on margin, like 3x, 20x. And it lurks and it's held through collateral. People like sort of pledging something that think that's safe, but when the price of that collateral drops, it triggers a cascade. And so I think people talk about this thing called auto deleveraging. So a lot of leverage, yes.
So the moral of that story there, and what's really scary, in my opinion, is if you get into the market when you start getting the financial markets actually really fearful, which we haven't reached that stage yet, but if you get this market to really start getting shaken up, right, where you get into a phenomenon like I ran through with 2018, where you start getting lower highs and lower lows, right, as the weeks tick on. Then you get in a situation where you could start to have a lot of panic, people freaking out, wanting to sell aggressively, and then you get even lower lows, lower highs, right? And that could make for a dynamic where you get some great pricing on some assets out there, but you get a lot of pain short term, right? And, something like Bitcoin maybe goes 75K, 70K, something like that, in a pretty quick amount of time. And then something like Ethereum can go from 4,000 to 3,000. Like, it can happen pretty quick in regards to the financial markets when it starts that cascading kind of selling market. You need more reasons to be fear. You need the government shutdown to continue to go longer, right? You need more worries about AI and how much is AI spend going to go up next year and who's actually making money from this, right? You need some more worries about the economy. Are earnings going to be there? Because if earnings aren't really there for the top of the market, right? If businesses pull back a little bit, if the consumer pulls a little bit back, like all it takes is companies to miss by 1% here, 1% there in regards to revenues. And next thing you know, those stocks start going down. You just kind of get this kind of ugly market in the short term, right? So, just something to factor in there, okay? I appreciate you guys for joining me. As always, thank you so much for being here. Once again, as I let you guys know, starting in January, to get inside my private group, it'll be minimum $100,000 net worth. So if you want to join inside my private group, get access to all my course curriculums, access to Discord chat, access to see exclusive weekly videos, the moves I'm making, and my nearly $4 million fidelity account, all that good stuff. Pinned comment down there. We got 2,500 members in there roughly, okay? It's Black Monday. It came and it went. I saw so many people talking about this Black Black Monday all over social media over the weekend. Oh my gosh. And what ended up happening is the public count ended up being up $50,000+ today. I hope everybody made some money out there. Here today, it seemed like just about everything was going up. It was a huge risk on day. People suddenly wanted to take risk again. You saw Broadcom stock up about 10% here today. Micron stock up over 6%. Oracle stock was up 5%. Tesla was up almost 5%. Salesforce was down up over 3%. People were ready to take risk here today, right? And they sold out of all the safety stocks, the stocks that you would expect to go up when people are really concerned about the market, the economy, those sorts of things. Look at SJM Smuckers down over 3% here today. Monster down over 3%. General Mills down over 2%. Procter & Gamble down almost 2%. The Hershey's Company, anybody wants some chocolate? It is at Halloween time, down about 1.5% here today. Meanwhile, you got oil screaming recession still at this point in time, being in the 50s. Oil prices screaming recession. You're seeing stuff like this. New vehicle prices top $50,000, while auto loan delinquencies keep rising. U.S. banks face new scrutiny over opaque loans worth $1.7 trillion. What is going on here? You got a stock like Oklo, $26 billion market cap this baby's sitting on. 26 billion, right? Now you say, this company, they must make a lot of money. They must have some big revenues, right? This company is pre-revenue, ladies and gentlemen. This is a pre-revenue company trading at about a $26 billion market cap. What is going on here? This company isn't even expected to have any revenue until 27, maybe 2027. And profitability, who knows? You could talk about that at some point, maybe in the 2030s or the 2040s. This is, pretty wild stuff, right? Meanwhile, you have Fastenal, a company that is seen as an economic bellwether, down quite a bit here today. And you might think it must have been their numbers were bad or something like that, right? Which means bad thing for the economy. Well, I'll show you exactly what's going on there and why that stock was down big here today, okay? In this video, 4 core subjects we're going to cover in this beast. Do I believe in the stock market short term or not? I'll cover that in this video, okay? Number 2, everybody knows I believe in the stock market over the long term, over 5, 10, 15 years. But what about over the short term? I'm talking this next several months. Do I believe in it or not? Number 2, does the economy even matter to the stock market anymore? That should be an important subject because people are looking at some of this economic related stuff and they're like, how's the stock market just go up and up and up? So we'll discuss that in today's video, okay? Number 3, a stock that everyone needs to own. We're going to talk about that stock in this video here today and how incredible it is, okay? Number 4, one of my stocks got upgraded here today. It was up huge. Goldman Sachs upgraded them. We'll talk about that. I want to share my opinions and perspectives. Okay, one thing and one thing only I need from you guys. I've been prepping this video for hours and hours worth of slides. The only thing I need from you guys is just please hit that like button. Make that little thumbs up button glow. If you could do that for me, it means the world. Everybody that's already done that, thank you, thank you, thank you. Additionally, if you want to be subscribed here to the channel so you can see more of my videos in the future, you should go ahead and do that because at the end of the day, if you're subscribed to the channel, higher probability YouTube will show my videos in the future. If you're not subscribed to the channel, lower probability. So if you enjoy my videos, make sure you're subscribed here to the channel. It's free to do so. You might as well, right? Alrighty, ladies and gentlemen, listen up. Reality is starting to hit. 4 hours ago, Johnson warns United States barreling toward one of the longest shutdowns in history. 3 hours ago, government shutdown could be the longest ever, Speaker Johnson warns. 23 hours ago, J.D. Vance, Vice President, warns of a deeper cuts ahead for federal workers, right? Remember I told you guys 2 weeks ago about this whole shutdown. I said, they're going to shut it down, and I think this is going to last a long time, right? And what I saw is Wall Streeters dismiss any possibility of this. They said, oh, they're not going to shut it down. And if they do, it's going to get fixed real quick. Boom, it's going to be right back up, right? And I said, we have the makings here of potentially one of the longest, if not the longest shutdown in history. And I don't think anybody's even prepared for that. We were looking at Robinhood has this kind of futures predictions market, right? And basically for only 19 cents on a dollar, you can basically place a wager that essentially the government will stay shut down for 60 days or longer, right? And so even now, still people aren't expecting this thing to drag on, right? And it has all the makings of a situation that could drag on. Now there's a potential that the Democrats give in at some point in time. There's a chance that Trump gives in at some point in time, does what they call the taco, right? And that's a potential. But I'm just saying, this looks like the makings of something that could drag on a really long time, and no one's taking this serious. The fact that you can basically make a 5-to-1 plus by basically betting that the government shutdown will last at least 60 days speaks volumes, I think, in the market we're in right now, right? And so the reality is starting to get there, but we haven't even gone close to panic mode. The longer this goes, the more you'll start to see people start to freak out and panic in regards to the situation. This is just the first glimpse of like, wait a minute, this is not good. Wait, this might actually drag on for a long time, right? No, if you look at the longest shutdowns we've seen in the past, you had the 95, 96 shutdown that lasted 21 days. You had 2013 that lasted 16 days. And as far as furloughed employees during those ones, 284,000 in this one, and then 800,000 in that particular one. The longest shutdown we had was the 2018 to 2019. That was 35 days. And that was about 380,000 individuals furloughed in that situation. This one's way bigger though. Okay, we're already 13 days. It looks like, honestly, I wouldn't be surprised if this went all the way to Christmas, or even into 2026. Like, I would not be shocked at all. Of course, one side could give in, but I'm like, this could go a long time. And 900,000 individuals furloughed in this one. This is huge, right? Now, the thing you got to understand about the 2018, 2019 time is we had a massive really colossal, downfall correction in the market at the end of 2018. But when that shutdown came, it was already when people had already done their Christmas shopping. We know Q4, that October through December timeframe, is always the big spending period, right? That's when people have their families in town. You have Thanksgiving, you have Christmas, you have Halloween, you have all these holidays. People are spending, they're buying gifts, all that sort of stuff, right? And so it didn't really negatively affect the economy during a time period when it could. This one's different. This one, we have the shutdown going on right now, right? And if this drags into November, December, this could actually affect Christmas spending, Q4 spending in quite a substantial way, right? So that's something to keep in mind. Did you guys see what the Treasury Secretary said today? This is really important. This was like back page stuff. This is big, guys. Okay. Very, very big. Now, in terms of the troops, right? There's talk that maybe even military members might stop receiving payments, essentially, like active duty, which is crazy, absolutely insane, right? Trump administration says they found funds that, maybe they can pay it all out or pay partially, something like that. We'll see what happens with that. But it's a completely kind of up in the air situation right now. But look what Treasury Secretary said today. He said, the shutdown is impacting the nation. This is getting serious. It's starting to affect the real economy. The Treasury Secretary said it's starting to affect the real economy. This is back page stuff right now, but believe me, this is going to catch up. And everybody's going to start freaking out and panicking over this situation. This is real, okay? Now, let me also say this. This is ridiculous. Like, the fact that military members have to worry about getting paid is insane. Like, if there's one group of people that should not ever have to worry about getting paid, it's military members. It's like people that are willing to put their life on the line for their country. The fact that those individuals have to worry about getting paid is disgusting, in my opinion. Like, we got to figure out a better system for that. Like, these individuals should never have to worry about that. That's the bottom line, in my opinion, right? And I know there's a lot of military members, active duty or, retired, that watch my channel. There's probably, if 100,000 people will see this video, I'll bet you there's probably at least 2,000 or 3,000 military members. Like, this is crazy, man. Like, you guys should not have to be going through that. That's ridiculous. It shouldn't be a question on if you're going to get paid. Like, that's just wild, man. No, Oklo, you look at a situation like this, right? Market cap sitting 26 billion with no revenue. I mean, that's the type of stuff where you look and you're like, hey, how can I trust this market short term when we've had this sort of froth in the market, right? Companies that are pre-revenue and maybe they start making revenue a few years from now, but we don't even know how much. We don't know even if they'll ever make profit. And if they do it, who knows how many years or decades that is away. That's crazy, right? You're looking at stocks like Palantir and Tesla, right? Which are many times like the poster childs of like the excess in the market. Forward P 300 plus on Palantir, 300 plus on Tesla, 200 plus on both those stocks for a 2-year out. Forward P, those are massive, massive numbers, right? And that's going to lead you to a very uneasy feeling and a market that's hard to trust when you have many of these stocks trading these sorts of valuations. That's scary, man. That feels like a market that could just break at any moment. If we didn't have this sort of situation going on, it wouldn't feel like that. But when you got crazy valuations, yeah, you feel like a market that could break at any moment, right? Now you have a company like Fastenal come out, right? This is a company I would call the real economy. The real economy, right? Like, they're a company that's used to build stuff. Like, this is the real economy, okay? But you look at a company like this, right? And this is seen as kind of like how's the economy doing and things like that, right? Now you see the stock was down quite a bit today. And the reason the stock was down is actually really, really scary in my opinion, because it actually wasn't like their numbers were bad. Their numbers are great. This was I graded this income statement. I posted inside my private stock group, a grade A income statement. Net sales was up 11.7%, gross profit up 12.5%, operating income up 13.7%, net income up 12.6%. That's a grade A, man. Not an A plus, but it's a grade A. That's phenomenal. Great job by that company, right? So it's not like their revenues are massively shrinking. So it's not like, there's like proof of some massive recession based upon Fastenal numbers right now. So what happened? Like, why did the stock go down? And why is this so scary for the stock market? Well, here's the deal. They missed their earnings per share by 1 cent. 1 cent. And it sent the stock down. That's the moment we're in at this point in time in the market. And you got to ask yourself, if the market was red today, how much would this stock have been down? My guess is it would have been down double-digit percentage. It was down 7.5%, but that was on a day when it seemed like almost every stock in the market was up. So this stock would have been down easily double-digit percentage if today was a decent down day for the market, right? Because they missed by 1 cent. That's a scary point in this market. And, you look at the valuation of the stock, 37 forward P for Fastenal, that's pretty high. 33 2 out forward P, that's the issue. The stocks run so much, the valuation is so expensive on a stock like this that anything goes wrong, anything, missed by 1 cent, and the stock's down 7.5% on a bright as green day as you can possibly have, right? And here's the thing you got to understand about the stock market, how these stocks move. Why certain times stocks could be reporting bad numbers and their stocks are going up. Certain times they report great numbers, a grade A income statement like Fastenal just reported, and the stock goes down 7.5% on a bright green day, right? Here's the deal. Stocks go very high, right? What does very high mean? It doesn't just mean like, the market's at all-time highs or stocks are at all-time highs. It means P ratios are very high. Forward P ratios, even 2-year forward P ratios are very high, right? Way higher than they normally are. So what happens is once they get sky high like that, you need stocks to report perfect numbers to keep going up. If they do not report perfect numbers, they start to go down. And that gets into a very rough cycle where the numbers get a little less perfect, and it just keeps going down. And then if they get to a point where they start reporting bad numbers, it's down even more, right? So then stocks end up crashing. They go through a crash, let's say, right? So, okay, stocks go through the 30% plus crash. A good example of that would be the Great Financial Crisis. Another good example of that would have been the Rona crash. Another good example would have been the 2022 when the NASDAQ went down 37%, peak to trough from where it peaked in Q4 of 2021 to where it troughed at in Q4 2022, right? So once you go through that crash, coming out of that, as long as a company's not like reporting awful numbers, like, oh my gosh, this is the worst thing we ever seen, the stock will start going up. Because people will start looking at it and be like, well, there's just 1 or 2 positive things. So the next thing you know, you see stock go up 10, 20%. And you're like, how? The numbers were dumpster fires, a grade F income statement or a grade D income statement. How's this company going up? It's because they already crashed. And so all they need is something good. So no different than the only bad thing you could really look at in his Fastenal numbers was they missed by a cent, right? Suddenly, all it needs is like 1 or 2 good things in a report, like 1 or 2 positives, like, we're talking about guidance for next year might be a little better, business for next year, margins for next year or next quarter might be a little better. Boom, stock goes exploding higher, right? Then we get back into a market again where stock get very high based upon P ratios, right? Next thing you know, you have a big correction, right? Stock, indexes go down like 10, 15%, somewhere in there. And then all you need coming out of that is decent news, decent earnings, something decent, and you start to go back up again, right? That's the game of the stock market. Eventually, when valuations get too high, you need perfection. And when perfection starts not being hit, guess what ends up happening? Your stock starts to fall and fall and fall and fall and fall, right? Now, I posted this yesterday on Sunday on X. I said, if there's a rally tomorrow, which is obviously today, right? I said, it will likely be a sucker's rally. And that's really how I felt in regards to this situation. I don't trust any rally in this market short term. And I mean none. None. By the way, if you want to follow me on X, I always have it linked in the description area of all my videos. Also I have my Instagram down there as well, right? But I post a lot of stuff on X very often. But yeah, the bottom line is like, I'm not a believer in this market short term at all. There's too many things working against it with valuations being too high. If valuations were cheap right now in stocks or even fair, I'd say, okay, I could trust rallies in this market. Not where we're trading at right now. No. Okay. So what did I do here today? Was I out there buying? No. So what was I doing out there? Well, I went ahead and added to a hedge position. This is my 2x leverage position against Tesla stock. I went ahead and added some more here today, okay? The bottom line is, if this market gets hit in any substantial way, we know Tesla's going to get hammered, right? You take the S&P 500 down 10%, Tesla's probably going down 30, or at least 25. And then we're talking 2x leverage, you're probably up 50%. Quick. That can happen quick. I mean, S&P 500 to go down 10%, dude, that could happen in weeks. That could happen in within 2 months. It's nothing. That's nothing. Just a 10% move. We're not talking about the S&P 500 crashes. We're not talking it goes down 50%. We're not even talking about any of that. Just a 10% move. That could happen in 3 weeks. That could happen. Like an S&P 500 is down 10+%, right? And if that scenario plays out, right, obviously this hedge will appreciate greatly. And the next thing you know, this hedge alone will be $60,000, $70,000, $80,000 worth of money that then I'll be able to cash out, reinvest into something else, right? Likely in long positions at that point in time. Same thing. I got some Palantir hedges on. We know Palantir would get hammered in that sort of situation as well. So, I'm covered either way. This market just keeps kind of frothing up here. I stay invested. I got massive amounts of money, obviously invest in the market. Cool. As market goes south, I'm covered. These will appreciate greatly in that sort of market, right? Now, this leads me into this. What's safe short term in the market versus what's risky long-term in the market, right? And so if we're thinking short-term, that's less than a year, right? Long-term means more than a year, essentially. So stocks are extremely risky in the short term, right? Cash is extremely safe in the short term. But over the long term, let's be very honest, cash is extremely risky because it's always being devalued over time, right? Stocks are not risky over the long term. Great companies do great things and make massive amounts of profits. So this is just something to kind of keep in mind in regards to, I don't trust this market short term. I don't trust this market at all for the next few months here. But that doesn't mean I'm going to cash out of all my positions and sell all my stocks. I think there's a risk that, if this market gets hit here in the next few months, I think there's a risk that the public count goes from $4 million down to 3.1 or 3.2 or somewhere around there, right? Which the public count, that's the one I started back in 2018 inside my prep stock group. They've been able to see every single buy and sell in that portfolio ever, right? Like, could I see a situation where that portfolio goes down 3.1, 3.2 mil, something like that? If this market really got hit? Sure. But that doesn't mean I'm going to sell out and try to play that game of like creating a massive taxable event for me, right? That I have to pay, I'm sitting on stocks at a massive amounts of money and then trying to worry about when to time back in. Okay, this is a perfect time. No. I stay invested because at the end of the day, just because I think something might happen in the market, right? Macro calls are hard to make. And so a lot of times you might not be right on that, right? So I'm not going to risk my whole portfolio by selling all my stocks just because it might go down, over the next few months. No, I'll stay invested with my long position that I love for the next many years, and I'll hedge myself a little bit. And I got cash around. So whatever way the market goes, we send this market down, right? My hedges will likely print money. And then I got a bunch of cash. I'm ready to flush in the market. Market goes up. Guess what? My hedges will likely decrease in value. That's fine. So maybe I lose $10,000 or $20,000 on those hedges, but then my long positions appreciate 100,000, several 100,000. If you add up all my portfolios, it's a big number. So whichever way, I got my bases covered in regards to this whole drama show here, right? Now, I saw this. Peter Lynch was actually talking. He doesn't talk that often nowadays. He said, if you own Costco, Walmart, Nvidia, those sorts of stocks offset your mistakes. Those stocks have been so amazing over the last 20, 30, 40 years, right? He said, you're terrific in business if you get 6.5 out of 10 times. That's a great score. And I posted this inside my private stock group. I said, something that's often missed in this game of individual stock picking, what I do and what a lot of you guys do. I said, you don't need every stock to make you money. You can even be wrong sometimes, right? No different than I could be wrong on this Tesla hedge, and that's perfectly fine. Like if this decrease in value and I lose $10,000 on it and I got to sell out at some point in time, that's fine. Like it is what it is, right? Like I'm never going to get 100% right. I said, this is to be expected. You need to do these three things. 1, be right more than you're wrong. 7 out of 10 right is good. 8 out of 10 is great. 9 out of 10 is legendary. 10 out of 10 is impossible. As much as I believe in myself, as much of work as I put in, my 17 years of being in the market, I will never get 10 out of 10 stocks right. Never. There's always going to be at least one I'm going to get wrong. And that's okay. That's perfectly fine. Even if I get 3 out of 10 wrong, that's perfectly fine as well. I could still make a lot of money, right? 2, you need your biggest investments to be the ones you're right on, right? Those ones are extremely important. You got to take low risk and have a high probability of making money in those stocks, right? Income statements, balance sheets matter a lot, and valuations, what you're paying for those stocks, matters significantly. Number 3, you need to find a game-changing company every few years. Those opportunities don't come around often, and don't get desperate to find them. They will come when they come. And that's in regards to finding that next Tesla, that next Palantir, the next Nvidia, right? That next AMD, whatever the stock may be. Those opportunities do come around, but you can't get too desperate for them. I see too often, especially newer investors to the market, let's call it less than 5 years experience. They try to get desperate to find that next one, and they take unnecessary risk and get into some stocks that are not really the next Palantir, the next Tesla, the next Nvidia, and they find themselves in a bad situation, right? But you got to focus on the long term in this game, even though you might not trust the short term. Because at the end of the day, whatever happens here short term, if we have a 10% correction, a 30% crash, whatever happens in the next few months, just understand it'll all be a blip on the radar in the end. It won't matter. 5 years from now, 10 years from now, 20 years from now, it won't matter. Just like the great financial crisis doesn't matter to the market today. Just like the Rona crash doesn't matter to the market today. Just like the Great Depression doesn't matter to the market today. Just like the crash of the 1980s doesn't matter today. The one in the early 80s. Just like the 1987 crash doesn't matter today. Just like the 2022 crash doesn't matter today. All that will not matter 3, 5, 7, 10, 20 years from now. But it's going to matter in the short term, right? In terms of the whole fireworks and the drama show. But you got to stay focused on the long term. If you want to learn from me on a much deeper level, apply to join my private stock group. There'll be a pinned comment down there. Access to my entire library of premium courses. Access to my private Discord chat. So you'd be in there with a ton of like-minded long-term investors. It's extremely valuable. 6, 7, and 8-figure members in there. We're talking just in their portfolios alone, right? Full access at 1000xstocks.com and see the stocks I'm buying and selling in my nearly $4 million Fidelity account that I started back in 2018 for that one, okay? That will be pinned comment down there. Let's get you up to a much higher level. And we'll send you your Steel membership cards to your house once you join us in there for 1000x and for your private group. And look at this. I just made a very nice 1000x pen, but I just made that for myself, okay? I'm not sending you that. Alrighty, next up here, number 2. Does the economy even matter to the stock market anymore? And then we'll talk about a stock that everyone needs to own. And we'll talk about one of my stocks that got upgraded by Goldman Sachs here today and what that means. Okay. Does the economy even matter to the stock market anymore? Well, what stocks drive the market? So what I pulled up here is the weighting of S&P 500, all stocks that are weighted 2% or more. Okay. Now keep in mind, Google's divided into 2 here, but basically Google's about a 5% weighting for the stock market. Okay. And why I want to do that is I want to show you like what stocks actually matter to the market. Like these are the ones that are going to drive the stock market up or down. Right. And I said, okay, think about their customer base. And does their customer, like if the economy gets worse, let's say hypothetically, in the short term, are their customers going to be affected, right? So Nvidia, who's their customers? Well, their customers are Microsoft, Amazon, Meta, Google, McDougal, Tesla, those sorts of companies. So as long as those companies are not too negatively affected by their businesses, then they can continue to spend massive amounts of money on Nvidia chips, right? And obviously AMD chips as well. Now, what about Microsoft? Well, Microsoft, massive amounts of businesses use Microsoft. So as long as the economy stays pretty good for businesses, then Microsoft should be okay. Should be, right? Now, when it comes to Apple, that's a massive consumer business. So if the consumer gets hit, that could hit Apple, right? Keep in mind, if the consumer gets hit, that could eventually affect businesses. But Microsoft's got such a stable business model, honestly, that I doubt they would see many people cancel their Microsoft suite because the business cycle was down. Amazon counts on businesses and consumers, so Amazon could definitely be exposed if things got worse, in the economy out there over the next few months, no doubt about that. Meta Platforms, consumer as well, right? So yeah, that one you can make an argument for. Broadcom, their customer base is a lot of big tech companies, so as long as big tech companies keep putting up great numbers, like they should continue to spend aggressively with Broadcom. Google, McDougal, business and consumers when it comes to Google, and then Tesla is just consumer. So then the day you look at it and it's like, absolutely, if the economy was to get worse, like it would affect the stock market. Absolutely. I know it hasn't in the short term, but at the end of the day, yes, it would eventually affect the economy, right? And you have some things working negatively against us. I spoke about this a few days ago on the channel, right? I mean, think about this for a moment. We got 1.6 million roughly federal employees out of work, not getting paid now at this point in time, right? How are those people buying stocks? They're not going to be buying stocks, which that affects the market. That's way less people inflowing money into the stock market that would usually be there on a week in, week out basis, right? And keep also in mind, when it comes to this large of an amount, some of these individuals might need to actually sell their stocks especially if this continues to drag on for the next several weeks, the next 2-3 months, some people are going to need to eventually like sell stocks to pay for expenses. So that takes them, not only are they not able to buy stocks, right, but then they have to start selling. So it puts selling pressure, if anything, on the market, right? Additionally, I don't know if you guys are aware, but health insurance is likely going to skyrocket in 2026. I was looking into some of this recently, right? And from my understanding, I have a family of 5, right? It's myself, my wife, and then we have 3 kids. So from what my wife told me, we pay somewhere around $2,000 roughly a month to health insurance. Just a crazy number, right? We're talking like 25 grand roughly a year in health insurance. It's a huge number just for us 5. Now, keep in mind, health insurance is the second biggest expense for a lot of individuals out there, including I looked at myself and I'm like, what's my second biggest expense in terms of like personal expenses? It's health insurance. Because I was looking, I'm like, so my mortgage obviously is the biggest expense. After that, the Ferrari's paid off, the Model X is paid off, and I do have a loan on the Model S Plaid, and that payment's less than $2,000 a month. And then I was thinking after that, I'm like, no, I don't have anything else that's over $2,000 a month. So that's literally my second biggest expense. And I bet you there's a lot of you guys watching this right now, health insurance is your second biggest expense in your life. So if this goes up a lot, it's going to pull a lot of money out of your pocket, right? So I was looking at this, right? The most dramatic increase are expected for more than 24 million Americans who receive financial help to buy coverage on the ACA marketplace. This is really interesting. They're talking about payments could more than double. And this is not a small amount of people. 24 million plus Americans over a double. Like, how are people going to do that? They can't do that. This is a complete disaster. Like, you're not going to have any money to do anything. What's going to end up happening is you're going to have to probably cancel your health insurance. Like, I don't ever see any other way around it. That's insane, right? Gross premium increase. And then if you are keeping your health insurance, like, whoa, it's just ridiculous. Gross premium increases even without the subsidy change. Insurers are proposing a median gross premium increase of about 18% for ACA marketplace plans in 2026. This is the largest proposed hike in several years. That's without the subsidy change. 18%? Ladies and gentlemen, keep in mind wages go up like 2 to 3% a year. So when you're talking about your second biggest expense is going to go up like 18%, this is a disaster waiting for the economy here, right? Look at this, employee-sponsored plans. A lot of individuals have employee-sponsored plans. I'm sure there's plenty watching this right now that maybe you're on an employee-sponsored plan of some kind. They're talking about even here an average increase of total benefit costs of around 6.5 to 9% for 2026. Listen, folks, wages are going up like 2-3%, somewhere in there. So you're losing to inflation, not in a small amount, but you're losing in a substantial way here. Small business plans, a median proposed premium increase for the market is around 11%. Brutal, ladies and gentlemen, brutal. So that's something that I think people should start taking really serious really quickly here. Now, you have a lot of other tax incentives and things ending that have been helping the economy, but that stuff's ending, right? For instance, the EV tax credits, that's all wrapped up now at this point in time. There's no more of that. No bueno. Not a good situation in regards to that. If you look at residential solar, that's had a massive tax credit for years, and that 30% credit that you're getting on new installations is now going bye-bye. So, the solar industry is going to be in a tough place for a while, right? And you can see that in something like Enphase's stock. Look at Enphase's stock since the end of 2022. It's down almost 90% now, ladies and gentlemen. Almost 90%. Enphase is in a brutal spot, man. Absolutely brutal. Meanwhile, what do I always tell you guys drives the actual economy? The thing that always drives the U.S. economy, in my opinion, is a new home being built. I always tell you guys, there's nothing better than a new home being built. The amount of jobs that come from that, the amount of workers that work on that project, from electricians to plumbers to folks that are laying the drywall on to people that are doing the roofing and the flooring and all the businesses that distribute those products around, right? Because all this stuff, all this lumber, all this, different products in general, it's always got to get transported. So many transportation companies make so much money off of all this, right? You have cabinet companies, you have people making the refrigerators and the ovens and et cetera, right? If you kill the housing market, you kill the economy. And I always tell you guys that. That's just the honest truth. because there's just so many direct and indirect jobs that happen when a new home is being built. But here we are at this point in time now, right, where if you look at how many homes are under construction, that number's been going down substantially, right? And the thing that's interesting about this is I think we're getting close to emergency levels. As in, if this number doesn't start to pick up quick, and when I say quick, I mean in the next 6 months, folks, we're going to have, this market's going to completely dry up, because you got to understand, a lot of these homes that are under construction right now and the numbers, like a lot of them are going to be finished in the next 6 months. So when those homes are then finished, and if you don't have the next massive group of buyers coming in, guess what? Cabinet companies start saying numbers aren't there. Companies that are building the fridges and the ovens and all that sort of stuff, right? And driving all this product around, the truckers and that massive industry. The lumber companies have to start laying off people. Like it's a whole ripple effect that happens there. And I think we're getting to emergency levels that if this doesn't pick up in this next 6 months, you're going to kill the economy is what's going to end up happening here. So this is a very, I think, serious matter that needs to be taken very serious. Now, where do I see a big change coming? If, in terms of people saying, you know what, I'm going to go out there and buy a new house. You need mortgage rates under 5%, in my opinion, to get a lot of people to say, yeah, let's go buy a new house right now. Let's go build something new. Let's go talk to Toll Brothers. Let's talk to KB Homes. Let's talk to Pulte. Let's talk to Century Communities. You need mortgage rates to go under 5%, and we're a long way from there, folks. Long way. We're still at like 6.3 right now. So you need to get into like the 4s to make most people say, okay, let's go ahead and do this now at this point in time, right? Now, keep in mind, the worst part of this whole situation is even if you get this hypothetical mortgage rates come down substantially, which is very possible, guess what? Housing inventory is starting to pile up. I was looking at my city, Las Vegas, and look at housing inventory here. So even if you have a situation where mortgage rates drop under 5% and people say, you know what, let's go get a new house. Let's go buy another house, right? Let's move. You got a lot of competition out there from the existing market now at this point in time, where people might not even go to build a new house. They might not go to see Toll Brothers or Pulte Homes or KB Homes or any of those guys. Lennar, they might say, you know what? I'm just going to buy existing inventory home, because a lot of those homes have been built in the last 5 or 10 years as it is, right? Especially if you're in somewhere like Vegas. And so you're getting a pretty new home anyways, and you might get a much better price, right? But the problem is that doesn't create that great ripple effect for the economy. When we're talking about you sell a new home, that's the great ripple effect for the economy. When a new home is built, right? For an existing home, it's not that great ripple effect. Like the best case scenario when somebody buys an existing home is maybe they go buy some new furniture, or maybe they fix up something small with the house here or there, right? But you're not getting that like, oh, we're building a brand new house and how many people make money off that. So we're at a moment of truth here where reality of the economy starts to hit the market, right? Which is an interesting time to go through, because it's been able to kind of brush it aside so far, but eventually it catches up with you, right? It always does. It always does, right? A friend sent me this photo. This is more funny than anything. His wife, I guess, went to Walmart, and right in the parking lot there, he said a brand new Rolls Royce looks beautiful. But yeah, when the Rolls Royces are parking at Walmart, it might be worse than we think, ladies and gentlemen. When they're driving the Rolls down to Walmart, might be worse than we think. It might be worse, right? Alrighty, folks. Next up here, let's talk about a stock that everyone needs to own. Then we'll get into one of my stocks that got upgraded by Goldman Sachs and what's going on there. Okay. So, interesting thing happened yesterday. I went to Whole Foods. I wanted to get some stuff to prepare for dinner. I was looking forward to cooking a nice meal, right? And my wife calls me. I was at the checkout. She said, we need milk. And I said, oh, shoot. I'm already at the checkout. I'm about to leave. I had my 3-year-old with me, and, going places with a 3-year-old's already a whole situation. So I said, I'm just going to look on Amazon. I never bought milk or looked at milk in my life on Amazon. I don't even know how that thought popped in my head to let me go see on Amazon to buy a gallon of milk, right? But I was like, I don't even care. This gallon of milk could be like $6. I don't care. It's more like my time's more valuable than like if I have to overpay for milk. And plus I was looking at Whole Foods. Whole Foods has milk. Whole Foods milk is so expensive. It's ridiculous. Like Whole Foods milk is like $4, $5, $6 a gallon as it is, right? Because I don't know, I guess they massage the cow's ears or give them like, therapy sessions or something like that. So Whole Foods milk's already out of control. So I go to Amazon. I type in milk, right? Pops right up for me. Guess how much a gallon of milk is on Amazon? This is going to blow your mind. $1.97. I said, what? That has to be like a typo or something. Like, there's no way that's correct. $1. I haven't seen a gallon of milk for $1.97 since the great financial crisis. $1.97. I'm like, is it a half gallon? I'm like, what? I'm like, no, this is legit. I'm like, wait, it's $1.97 and they're going to deliver it to my house in 4 hours from now for free? Okay, let's go ahead and do that. And I asked my wife, I said, you see gallons of milk $1.97 anywhere? Because she does the food shopping all the time, right? If I go to the grocery store, it's for like a freak situation because there's like something specific I want to cook. So I'm like, oh, I want to go on the weekend to a grocery store like Trader Joe's or Whole Foods or some other grocery store. You got to get some specific items, right? And she said, no, you can't get milk for $1.97 in any of these grocery stores. Like, no, it's at least in the 2s, if not in the 3s or 4s for a lot of them, right? That's a problem, ladies and gentlemen. That's a problem, right? You look at Walmart. Walmart does about 60% of their U.S. business from grocery. And I used to shop at Walmart back in the day when I was, money was very, very tight from 2009 through 2011. I used to shop on the regular at Walmart. Like, that was a place I went because Walmart usually had the cheapest prices on a like everyday basis, basically. Sometimes you get better deals at a grocery store, but you needed to do something crazy, like buy 4 of some item or whatever, right? I usually found that Walmart was the cheapest. So, 1 out of every $4 roughly is spent at Walmart with grocery. And I'm looking here and I'm like, oh boy, like you guys got something coming for you in regards to this situation, right? Like the grocery stores, I would not want to fight Amazon in regards to this situation, right? And you look at AWS's operating income, Amazon Web Services, operating income last quarter, $10 billion plus. That's 11 figures, ladies and gentlemen. Operating income the previous quarter, $11 billion. Operating income the previous quarter, $10 billion, right? Kroger doesn't have that. Walmart doesn't have that. None of these grocery stores have that. How do you compete? If Amazon wants to get serious in groceries over this next 5 years, which you start selling gallons of milk for $1.97, I'll say you're getting pretty serious. And you're going to deliver it to people's house for free? You don't have to go to the grocery store and push around a basket and, are you kidding me? I would not want to fight them. That's impossible. You're never going to win that war. You're never going to win that war, right? Jeez. And it's just a matter of time before they go after the big dog, right? It's just a matter of time before that happens. So this is going to be brutal. And so at the end of the day, Amazon stock, you got to own this stock. And you got to understand this stock is a buy in every market. I don't care if the market goes up a lot, down a lot, sideways a lot. Amazon's a buy. Amazon's a buy and a buy. Every day, every week, every month, and every year since this company went public back in the 90s, the stock has been a buy. And here today in 2025, it's still a buy. There's a reason it's a big position for me in the public count, $331,000 position. I own it in other portfolios as well. I own it almost in every one of my portfolios. At the end of the day, like Amazon's a must buy. Show me one time since this company went public in the 90s where it was not a buy. It doesn't exist. It literally, you could have bought it at the peak of the tech bubble. You could have bought it 6 months later, 6 months before, 12 months later, 12 years later. Doesn't matter. It's always been a buy. It's still a buy. It's a stock everyone has to buy. Everyone has to hold as a core position because you have that insane e-commerce growth that just continues to go up year after year. It looks like they're about to push heavy into grocery, which is a massive market and going to get everybody even more in a normal basis to actually go to Amazon to order everything. Like that's the one component that's kind of been missing from Amazon over time is like grocery, right? It looks like that's going to stop going. That's going to stop being a problem as well. And then they got the AWS business, which is massive. They got the ads business, which is huge. Whew. Like it's incredible. And so this is a stock you got to own, man. You don't own it. And it's like, why not? Why wouldn't you want to own it? Like they're the one company that you can't compete with. You can't compete with them. You literally can't compete with them. I don't care who you are. Amazon comes to compete with you. It's just good luck. Good luck, man. It is unbelievably tough to compete with those guys, right? Because here's the deal. If Amazon wants to start selling gallons of milk for 99 cents, they could do it. If they want to start giving away milk for free with every grocery order over $30, they could do it. A grocery store can't do that. They don't have the margins. Walmart can't do that. They don't have AWS. They don't have that massive ads business and all. Like, you can't do that if you're those guys, right? Target, another one. They've been actually growing nicely in grocery over the past decade, but whew, It's tough, man. Brutal. So the moral of the story is own Amazon because, they're just an impossible force to compete with. Now, one of my stocks went up a lot here today, got upgraded by Goldman Sachs. We'll talk about why this happened and those sorts of things and my thoughts on this. So this was my best stock here today. Estee Lauder. Stock was up almost 6% here today, up $9,000 here today. That stock is now up almost $42,000 for me in the public account. My best stock. So in regards to today, that is, in regards to Estee Lauder, what's going on here? Okay, now is the time to load up on shares of Estee Lauder, Goldman Sachs. Estee Lauder is turning a corner and could return to top line growth as soon as the fiscal first quarter of the year. With double-digit EBIT, that's earnings before interest, taxes, margins, by fiscal year 2027, which is coming up very soon for them, their fiscal year. This is not calendar year, this is their fiscal year, which is way before their calendar year. As the company's efforts to right the ship earns an upgrade to buy from hold at Goldman Sachs. The analyst Bonnie believes that the cosmetics company has entered a fundamental inflection point driven by strategic initiatives put in place by the management, including brand launches on Amazon. Awesome, love to see that. Oh, by the way, everybody wants to launch on Amazon. Right? Nike just launched a store on Amazon very recently, and they said their demand's been much better than they had anticipated, right? Estee Lauder says we're going to have to launch our brands on Amazon. Everybody has, Amazon's, you got to be there, man. And TikTok and its consumer-first approach to drive faster innovation. Quote, we believe management is taking steps in the right direction with its beauty reimagined strategic vision, and improving trends in the Chinese market. And that makes the stock an attractive buy at its current levels, advising clients to, quote, load up on shares. Load up on shares, right? Yeah, there's no doubt. There's no doubt. Like, at the end of the day, the reason I bought Estee Lauder stock is for those brands. Like, they're brands, you can't replace them. Those are phenomenal brands. It was just a matter of time for the management team got those brands in a position to really understand the new economy. The old management team was too focused on like the historic business, which is like selling in Dillard's, selling in Nordstrom and Macy's and these different department stores and things like that. And that's cool. That's still a business that exists and that's fine. But you can't count on everybody just going to those sorts of stores. Like people want to shop on TikTok nowadays. Okay. Like the amount of women that I know that will buy stuff on TikTok is a pretty large number. People want to shop on Instagram nowadays through Instagram Shop. People want to shop on Amazon. Guess what? Amazon, right? Like, this is what happens. Like, this is a new age economy and you've got to have a digital strategy. You've got to be great as far as your marketing on digital as well. Look at how well e.l.f. has done. e.l.f. has built a serious, what is going to grow into a massive cosmetics company now, right? Through digital. Look at the Rhode company that they acquired here recently and what Hailey Bieber's done there through creating that business and growing it through digital, right? And look what, obviously Kylie Jenner did, many, many, many years ago now at this point in time with her brand. And that was all digital. Like, you got to be digital in this age. And Estee Lauder was, just a historic company with phenomenal brands and phenomenal products. But to focus on just physical retail, you got to focus on also digital. And they're doing that, right? Now, I saw comments like this out there. This individual says, laugh out loud, right on schedule after the shares have nearly doubled off the lows near $50, which, yeah, the stock was in like the 50s range back in, that was during the whole tariff drama back in April, right? This one says, looks to me like time to load up was in April. Yeah, fair, right? Time to load up was in March and April, right? And so a lot of people are kind of making fun of this analyst from Goldman Sachs and saying, it was the time to load up in March and April. And I agree, like that was the time to load up. But you got to understand this about these analysts is a lot of times they will not start going positive on stock until they get a lot of proof that like a turnaround's happening on a stock like this. And also they won't go really positive like this until the stock price has already started to go up significantly. So in the further that stock price goes up, the more analysts that come out and start getting positive and positive and positive. So you actually this is kind of like first or second inning in regards to the Wall Street community starting to turn positive here in EL stock, Estee Lauder. But, that's just kind of something I want to say. And another thing I got to say in regards to EL stock is you understand this stock is, oh my gosh, I think a bird just hit the window. Windows must be too clean or something. This stock was $370. $370 a few years ago, right? The stock today is $92. That was before the inflation hit and they had really troubling numbers over the past few years. And so just understand this stock could go back to 370 over the next number of years, right? And even if it doesn't go to 370, you could say it could easily double to like a 180. Could it not, right? 180 would be, guess what? Half of this number. So the stock, even if this goes to 180, you're still going to be down 50% from where it peaked at back here. So understand there's a long way to go here. And the way I put it to you like this, Meta stock, the crash happens in 2022, right? Meta stock goes into the 80s, $88 at the lows, right? I still have some shares in the public account that I bought at 93.12. And there was a big batch I bought at 88.94. I can't remember if that was this portfolio and I already, cashed those shares, or there was a different portfolio. 88.94, I remember I got some at. But this batch here, the 650, was at 93.12. The stock went all the way into 80, like 88.04 or something like that it bottomed at, right? So it goes from the 80s and then it goes to 160. Wall Street starts to slowly get a little more positive on Meta and the turnaround, right? So at that time you could have said, hey man, stock's doubled. Like, where were you guys at? Like, this is silly. Now you're upgrading it. Well, you should have still bought Meta at 160, because guess what happened? Meta then went from 160 to 320 and Wall Street got even more positive on the stock. And you could have thought, okay, we're almost back to all-time highs in the stock. There's not more upside ahead. Then the stock doubles up again right in your face, goes to 640, right? Now the stock today, 715. The stock, I would say within 12 to 18 months from now will be $1,000 plus. $1,000 plus on Meta within the next 12 to 18 months. So, are we going to double this one up to 1280? Yes, we're going to double this up to 1280, and it probably comes in the next 2 or 3 years. So just because you missed a double up doesn't mean there's not another double up coming. Like, when you got that sort of opportunity to massively grow earnings, you got it, right? Now, I posted this also on my X page. I said, let's start preparing for 2026. Fireworks are going to be here at the end of 2025, but we already need to be on 2026 mentally. We must grow our wealth every year despite market conditions. That's very big, ladies and gentlemen. I don't care what happens next year. We've got to grow our wealth. I don't care what happens the following year. We got to grow our wealth. We've got to take this no prisoners approach to our growing our wealth, where we got to say, we don't care what Trump does, what China does, what the tariffs do. We're going to find ways to grow our wealth regardless. And it's hard to do, especially if you're in a big downward market or things are volatile. I don't care. We got to grow our wealth. That's the approach you got to take year in and year out, and expect that from yourself. Expect to grow your wealth every single year. Doesn't matter what happens in the market. Some years maybe are going to be banger years for you and you're going to massively increase your wealth. Some years might only be a slight increase, but we got to focus on growing every single year. At this time next year, we need to be richer than we are right now. At the following year, we need to be even better the next year, right? Not always easy to do, and that's fine. We don't mind putting in the work. We can grow in 2026. If you like putting in the work and you like growth, you want to apply to our private stock group, that will be the pinned comment down there. Access to my entire library of premium courses, access to my private Discord chat, access to 1000xstocks.com, access to see the stocks I'm buying and selling each week, my nearly $4 million Fidelity account that I started back in 2018 in there. Get your membership cards, put them in your wallet, bust them out. Then when you see me in the future, you're in Vegas and you see me on the strip or wherever, and you say, hey, Jeremy, look at, I got the cards, baby. Boss. Much love and have a great day.